investors are not only worried about the economic outlook, but the whole structure of the international system.
We all really appreciate that if global trade begins to destabilize, all that we have to lose.
Our overriding theme, of course, is uncertainty.
The world economy cannot afford a continued confrontation between the two largest economies in the world.
The world is holding its breath, waiting for the U.S. to indicate where it wants to end up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, heading towards a solid week of gains as President Trump dials down the temperature.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
So as the White House says they had a meeting, China continues to say that negotiations aren't actually happening, leaving the clock ticking and the pressure rising following forecast cuts at Pepsi and P&G, American Airlines pulling its outlook, and Southwest CEO stating, "I don't care if you call it a recession or not. In this industry, that's a recession." In some places, Lisa, the damage is already done.
And that is really the big takeaway from this week. And I do think this has been a pivotal week because it turns out that on again, off again, potential talks underscores that it does seem like mutually agreed, mutually assured destruction is a motivating factor for talks. And that seems to be the consideration both for corporate America here in the United States, as well as what's going on over in China with industries that are hinged to U.S. industry, whether they like it or not.
The tone is better this week. The equity market performance is obvious. Equity futures up again this morning on the S&P 500. Does it matter if talks are happening or not when the president clearly wants to send the signal that he's ready to bring these tariffs down?
Oh, I think it matters, right? At some point, you want to see whether or not there are going to be contours of a deal between the two largest economies in this world. The question is, who is the they the president is talking about? And if there was a meeting, usually he'd be very excited to say, my Treasury secretary, my Commerce secretary, my NEC director met with their counterpart. There's still hope that a meeting will take place, though. Remember in February, Scott Bessent sat around the table with us and said, I will be meeting my Chinese counterpart for the first time during the IMF World Bank meetings. We heard from the PBOC governor today. He's leading a delegation here. There could be a meeting that takes place. There's still time.
Let's see if we get both sides to agree that that meeting actually took place before we get into the weekend. Going into the weekend, 3 days of gains on the S&P 500, looking to make it day 4. Equity futures higher by 0.25%. Coming up this hour, Sarah Hunt of Alpine, Saxon, words with stocks on a 3-day winning streak. Sarah Bianchi of Evercore on US-China trade talks, and Scott Devitt of Wedbush on Alphabet's better than expected results. We begin this hour with stocks heading towards a solid week of gains. Sarah Hunt of Alpine Saxon Woods writing these shifting tariff rates and timeframes will likely to continue to sow uncertainty. Sarah joins us now for more. Sarah, uncertainty is a word we've all been grappling with. I think that Andrew Hoddenhorst of Citi has summed up things nicely. Tariff headlines reduce tail risk, but lack detail and still imply a large increase in effective trade costs. Sarah, with that in mind, how do you approach this market now?
Well, I think right now we've got a lot of different dynamics that are happening at the same time. And one of the issues is as these tariffs move around, you see a lot of pull forward. So it's likely that a lot of the economic data is going to start reflecting the fact that people are thinking, well, if I'm going to buy something, I better buy it now. And I think it just makes this year very difficult to look at the estimates and look at what's going to happen, because how much of that pull through is early in the year, how much of it slides in the back of the year, or do we keep chasing it if the target times keep moving? Does that data keep getting better because people keep chasing things in case those tariffs come? So I just think it's very difficult to look at what's happening this year with any certainty.
Sarah, do you think at some point in the next couple of months there might be an air pocket in the economic data?
I think there could be, but this is where I'm looking at what's going on, and even just the anecdotal choices that people I know are making, which is, well, if I need a phone, maybe I should replace it now and not wait until September. If I need this, maybe I should do that. So I don't know that you're going to get that much of an air pocket in the near term. The question is what's going to happen if you pull forward too much, and do you get an air pocket later in the year once everyone's starting to think that everything is okay? And I think that's why this year is a very difficult one to game out this early.
Sarah, since Liberation Day, it's felt like a roller coaster in markets, a roller coaster of emotions on Wall Street analysts' desks where they've revised downward their economic projections. The S&P is down 3.2% now since Liberation Day on April 2nd. Does that account for the potential economic damage that CEOs are telling us is happening right now in real time?
Well, I think that we've gotten a window into some of that damage as you've seen this market be so volatile, because it may be down 3% now, but we've had a couple of days where we've seen some recovery, and we had that massive recovery a week or so ago. So I think that the market has been reflecting the uncertainty and has been discounting some very dire scenarios. And what I think this week has shown is that when some of that rhetoric starts to get a little bit less frightening and you start talking less about doing things that are quite outside of the regular thing, like getting rid of a Fed chairman, and you start talking about bringing some of those tariff talks down and being less aggressive about that, then the market is starting to play out and say, you know what, maybe there is going to be a solution versus a week or two ago when we thought maybe there won't be a solution. So I think that volatility still stands. And what we're seeing right now is a quiet period, which, you know, from those of us who trade is sort of nice.
There's the trade on again, off again kind of discussion. We'll get to that in a second, though I am wondering how much we're conflating the trade uncertainty with the big tech uncertainty. We got Alphabet earnings yesterday, and they were better than expected. They indicated that the demand for large tech and some of the chips isn't necessarily diminishing in any kind of way, and they were doubling down their investment efforts. How much is that almost a bigger piece of the support to markets right now than questions that keep swirling and maybe progressive talks in Washington, D.C.?
Well, that's a great point, because one of the reasons that the market was also feeling so volatile, I think, was that concerns about that AI spend had started to creep in when people started talking about whether or not there was enough data center capacity. And then some people were pulling back on building data centers, or maybe they didn't need as much. And I think that was as much of a problem for the market as the tariff situation was, because the AI story was really a big part of what got people interested in tech stocks, especially last year and the year before. So I think that staying there and those investments continuing to be made is a big part of the CapEx story going forward. And so I think that is also a key part of what happens this year. So it's good to see that come through in some of those discussions and those earnings.
Sarah, that's what the Treasury Secretary said to me when the Mag 7 stocks were taking a hit. He said that's a Mag 7 problem. They have a deep-seek problem, not a MAGA problem. When it comes to what you do right now, the team over at Bank of America is saying investors should sell into these rallies. There's more to go. And they say that this will continue until the Fed starts cutting, U.S. reaches a deal with China, and consumer spending stays resilient. That's when you can see the trend upward actually stick. Do you agree you need all those three parameters?
Well, I think a lot of it depends on your time frame, right? If your time frame is the next 3 to 5 years, then those parameters will come into play. If your time frame is very short, or you need money on a short-term basis, then I think that there's something to be said for that, because we have had the market come back after a real drop. And I think we've got more volatility ahead on these headlines, as we've been talking about, because right now there is nothing certain. What we're going on is a lightening of the tone as opposed to any factual changes that have happened in these tariff regimes. So I think that there is a lot to be said for near-term needs for liquidity and doing something like taking some money off the table. But if you're invested on the long term, I think that this is something that we just have to get through. And once we get through it, you'll start to see reasons for people to be more optimistic.
Well, this is what John asked me at the start of the program. Is the tone enough? Because it shows the direction of travel where this administration wants to go.
Right now, the tone is enough, and especially after some of the tone that had been much more negative and some of the declarations that seem much more problematic for markets. So I think that right now the tone is enough. It will not remain enough all year. So you're going to have to see some agreements come through, and you're going to have to see, I mean, you're already seeing the fact that China is talking about taking some of the tariffs, and we're talking about some of the tariffs. People are starting to understand how problematic it would be if we don't get somewhere where there's some agreement. But I do think that you've got more up and down going forward, because right now we've just come off of a period of problematic discourse versus quieter discourse.
Sarah, it does seem like we've learned something this week. We've learned something when it comes to CEO commentary, and we've learned something when it comes to foreign leaders and how they're approaching President Trump, their approach to the dollar, their approach to treasuries and their safe haven status. At least the rhetoric has been really supportive, saying that, no, actually, we need the treasury to be that haven asset. The dollar will be the reserve currency. Does that give you any conviction? Basically, do you believe them that there isn't this sort of bigger shift away from the dollar and dollar-denominated assets over the longer term?
Well, I think that you can make an argument about why there should be an alternative to the dollar, but in practical reality, there really isn't that much of an alternative to the dollar. On the margins, money can move around and capital flows can occur, but the U.S. markets are still the most liquid and the deepest. And I think that the U.S. market is also, from a consumer standpoint, one of the most important markets in the world. So there has to be some ability for companies and countries to come to terms with what's going on. And we have been discussing for years some of the trade imbalances. So I think that there is a recognition that while this may be painful to go through, it's not an untoward idea that this should start to shift and some of these regimes should start to shift. So I think that there is a lot of trying to figure out exactly how that comes out and where you want to be positioned. But the U.S. is still going to be a major piece of that no matter how it shakes out.
Hey, Sarah, appreciate your input. As always, Sarah Hunt there of Alpine, Saxon Woods on the equity market. A better week, heading towards a week of gains on the S&P 500. 3 days of gains for the first time since April 2nd. One small problem, though. You are continuing to see bonds and stocks trade in lockstep, and we'll see if we can break that trend sometime soon. For now, equity futures just about positive on the session by 0.1%. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Yahara Hekes. Hey, Yahara.
Good morning, John. We start with the latest on trade, with China continuing to deny it's in talks with the U.S. about a deal. A China Foreign Ministry spokesman said this morning the White House should not mislead the public about talks. Bloomberg News has learned China is considering suspending its 125% tariff on some U.S. imports, including medical equipment and industrial chemicals like ethane. Meanwhile, in earnings, Alphabet shares are higher 5.6% in the pre-market. The Google parent reported first quarter profit and revenue that topped analyst estimates, driven by strength in its search advertising business. Alphabet remains heavily invested in AI, boosting spending on servers and data centers. It's a different story over at Intel, with shares falling 6% in the pre-market after the chipmaker's second quarter revenue forecast missed estimates. The CFO warning that a tariff-fueled recession could hurt chip demand. And Intel confirmed our reporting that it plans to cut management jobs as its new CEO, Lip Bhutan, attempts to turn around. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later on this hour. Up next on the program, the president dialing down the temperature.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is.
Up next on the program, Sarah Bianchi of Evercore, live from Washington, D.C. this morning. Good morning. 3 days of gains on the S&P 500 this morning, and good morning, just about positive again by 0.2% on the Nasdaq 100. A similar move. Under surveillance this morning, the president dialing down the temperature.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
So here's the latest this morning. President Trump insisting trade talks are taking place between the US and China. China once again denying any negotiations are taking place. Bloomberg's Tyler Kendall joined us now from the White House for more. So, Tyler, have we got any confirmation as to whether those talks have actually happened?
Yeah, hey, John, I guess it depends on who you ask, as the ongoing disconnect between Beijing and Washington continues, with President Trump there, as you heard him, saying that those talks are indeed happening, but declining to really give us many specifics, including on who is conducting them. We do, of course, know that one of the preconditions for Beijing is that somebody other than him lead those negotiations. And we should note there is a Chinese delegation here in Washington this week for the IMF spring meetings, but at this point, there have been no official bilateral talks announced. But it does come as we could potentially get some updates on de-escalation. Bloomberg News new reporting this morning, according to people familiar, that China is considering exempting some U.S. goods from tariffs. These would be in certain sectors where Beijing is more import reliant, such as medical equipment for things like imaging and ultrasound devices, as well as industrial chemicals used for things like plastics and cooling agents. The reporting also does indicate that potentially plane leases could also see tariffs waived as well. A source familiar does caution Bloomberg at this point, everything is so in flux as we try to parse exactly what is happening here when it comes to U.S.-China trade talks. But it is clear, John, that the administration wants to push out progress when it comes to other trade talks. Just yesterday, the Treasury Secretary Scott Bessent saying significant progress has been made towards an agreement of understanding with South Korea, of course, one of those countries that has been given priority during these trade talks. He declined to give us specifics, elaborate on exactly what that could look like, but did say that they were working out the technical details as soon as next week.
Yeah, it was interesting. The Treasury Secretary yesterday in the Oval Office with the president saying he was actually surprised at how quickly the meetings were going with South Korea. What about what's going on with Japan and India? Is the U.S. making any progress when it tries to ask its partners and trading allies that they want to basically form a bloc and confront China together?
Right. Well, Annmarie, Bloomberg had some very important reporting yesterday that Japan is prepared to push back against the U.S. if the U.S. does ask it to curb its own trade against China. Now, we should caution, our reporting indicates at the moment the U.S. has not quite made that ask just yet. But we do know, of course, that it's something that this White House has been mulling, and it's something that China has come out preemptively saying that they will take any countermeasures against any of those countries that do come to take action against China that the U.S. would like to see. Our reporting indicates that could include asking countries to stop absorbing excess goods that are going to come into the market from China's overcapacity, as well as working with the U.S. to give us more favorable trade deals over what they are currently dealing with when it comes to China. So it really has put some of these countries in sort of a hard place, considering how geographically close they are to China, but also that this White House has made clear that they are prioritizing those countries like India, like Japan, like Vietnam, that are so close to China. So sort of a give and take on both ends there. I will say earlier this morning there was reporting that we are moving closer to one of those framework deals, particularly when it comes to India. We know that the U.S. would like to see them boost their crop imports when it comes to U.S. crop imports. So we'll have to see how that one develops, but that is another key one that we are watching.
Tyler, thanks for the update. Tyler Kendall outside the White House. More from Tyler a little bit later this morning. Here's a take from Washington. Sarah Bianchi of Evercore writing, we believe Trump will find a way to lower the tariff rate on China in the near future to somewhere in the 50 to 70% range and try to find some way to not make it feel like a unilateral concession. Sarah joins us now for more. Sarah, good morning. Good to see you.
Hi, nice to see you.
So it's time for some imagination. What can he do to do just that?
Well, I think he does need to be creative because President Xi is not really making this easy for him, and I think playing the situation quite well. But I think this president's extremely creative, and I think he will find a way. I think he's feeling pressure, listening to the retailers who were in the White House this week, watching the markets, really seeing the impact of 145%. That's almost an embargo, essentially. So I think he is just going to have to do that Trump magic and find a way to say that we've all agreed and pull this down just a little bit, at least in the meantime.
Sarah, at the moment, is he basically negotiating with a brick wall?
Well, I think that this administration has realized, and this president has realized, that the April 2nd, the liberation date, was too much and too far. And it's not only, we always ask, what's the Trump put? And I think the bond markets have made him nervous. I think some of what he's hearing from real participants in the real economy. And so we are seeing him walk back. We saw the exemption on electronics, which was huge. We saw a real indication from the White House that they're really moving forward on these talks with other countries. Having done trade negotiations myself, I can tell you maybe they're going to get a framework quickly, but the nitty-gritty of these details are really challenging for this country. You got to have a lot of conversations about agriculture and beef and other things. I think they got more work cut out for them than they may think.
How I read is that the framework will be enough to keep the reprieve going, and you're not going to see those sky-high tariff reciprocal rates. But how long to get an actual agreement?
Well, it can take time. And I think one of the things that they are not fully thinking through is that a lot of these countries, take a Japan or a South Korea, they don't just want relief on the reciprocal. They need relief on some of these sectoral tariffs. autos, electronics, other spaces. And so that's what's going to kind of really be driving them a little bit. I know right now the White House says, look, we think sectoral, that's national security, that's about reshoring. I think they're going to have to give a quick break. But in terms of, I mean, look, depends what the deal is. If it's, trading rice for LNG, sure, you can do that really fast. But if you want to get into the issues that the president really has identified as the problem, trade deficits, ag access, auto access, takes a long time.
Do we have a sense of who's leading these negotiations, who the architect is of the ultimate goals and the nitty-gritty, as you talk about?
Well, it does seem like, it sounded like yesterday they did a 2-on-2 with South Korea, and that I think is Bessent and Jameson Greer. Look, I think those two are the right people to lead it, but I think the Treasury Secretary will find that when you get into some of these topics, you really want your trade negotiator there. Again, these issues can go really weedy. How long the calf can be alive before we take the beef. I mean, I'm nitty-gritty, so I imagine ultimately a lot of this will get handed over to USTR. It's exactly what they know how to do. They're excellent at it. I just don't think anybody is even thinking you could operate on this time frame.
It seems like practical considerations and the reality of financial pain really is getting to the White House in terms of the meetings with some of the retailers. Do you have a sense of how much it's getting to the Chinese authorities at a time where they've expressed a great deal of patience, even though they are also experiencing a great degree of pain?
Look, I think, of course, they are, and this is not a good for either economy. And particularly on particular exports like chips and other things where they very much depend on the United States. But they do have a higher pain threshold than the United States. And I think my sense, being in the region, I'm actually on my way out there Sunday, is that they've been planning for a return of Trump for a long time. They've studied who was successful with him. They understand that if the United States retailers can, help negotiate this down before they even get in the room, that's really helpful.
You talked about the Trump magic earlier, but now that everyone knows his playbook and how he operates, is it much harder for him this time around?
Well, I think people are seeing, they are watching.
Because it looks like he's blinking.
Yeah, look, I mean, so far we have seen simply, I mean, I know the White House wouldn't want to call it unilateral retreats, but they do very much feel that way. Sometimes when you put too much pressure on the system, it feels like it's going to break, and it might. I think that's what they're feeling. I think most people would say the amount of tariffs at one time taking our country to the high 20s of a overall trade rate, import rate from, low single digits is too much for the economy at once. And so I think they are pulling back where they feel the pressure valves. I think the other thing is it's confusing to these countries exactly what they're solving for. We hear that from these countries all the time. What do they want? You saw Vietnam come in and say, well, we'll reduce our tariffs. That's not what this administration wants from Vietnam. They want some bifurcation, some distinction from China. That's much harder.
We've had the same problem this week here in Washington. We've asked various finance ministers, what is the ask? They've been very diplomatic about how they talk about the United States and the White House for obvious reasons, being here in the nation's capital, but they never really describe what the ask actually is. The ask from Wall Street right now is to move the conversation onto taxes and do it quickly. How quickly can we do that in Washington?
Well, I think you can move, again, you can do a framework and you can do transactional deals. But if you want to have anything that remotely solves the problem that the president identified, whether it is trade barriers or reshoring or any of these things, it's complicated. I think the first Trump administration, they did a very narrow Japan deal. It took a year. So I think we are going to get into a delay here, which unfortunately the market may be okay with, but the real economy is going to have a bigger problem. And these things are going to take months. Now, again, some of the countries are easier than others. And the other thing I think the White House isn't a surprise for is some of these countries, South Korea, Japan, they cannot go back to their countries with a deal that doesn't have some relief on autos.
Sarah, it's good to see you. Thanks for dropping by. Sarah Bianchi there of Evercore. One of these stats of the week for me that I saw from Ryan Pedersen of Flexport, good friend of this programme, runs a logistics firm. He put this out. In the 3 weeks since the tariffs took effect, ocean container bookings from China to the United States are down over 60% industry-wide. And I imagine that's what the retailers, the likes of Walmart, Target, Home Depot were warning about at the start of this week to the president, that the shelves could empty pretty quickly in the next several weeks unless they do something about what is effectively, in the words of many, an embargo. Coming up on this programme, we'll catch up with Scott Devitt of Wedbush following a big quarter for Alphabet. That stock up in a pre-market. Equity futures just about positive. On the S&P here, we're up by 0.1%. heading towards a solid week of gains on the S&P 500. 3 days of really decent gains of more than 1.5%. Equity futures this morning just about turning negative, but no drama compared to the gains we've seen over the last few days. On the Nasdaq 100, just about negative by not even 0.1%. With 3 hours to go until the opening bell, let's get you some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. It continues to be all about earnings. We had Google after the close, Alphabet reporting a really solid set of results driven by their advertising, their Google search business. They also had a good cloud result, too, thanks to AI. So those shares up more than 5%. There'd been a lot of concern about Google heading into this result. Would the macro environment mean, for example, that retail advertisers pull back? We didn't see evidence of that. So things like CapEx continue at a healthy pace. You can't say the same for Intel. In fact, they talked about cutting CapEx. They talked about cutting employees, matching the Bloomberg scoop from earlier in the week. Those shares declining 6%. It was the first earnings set of results with the new CEO. Basically laid out wafer-thin expectations. Didn't give any splashy numbers of goals that they wanted to reach, and talked about having to make difficult decisions ahead. Another rough set of earnings came after the bell yesterday from T-Mobile. You can see that reflected in the share price, down 5.33%, adding less mobile subscribers than expected. Not as bad as Verizon, which lost subscribers, but still another bad set of results. It seemed only AT&T out of the 3 big had a really strong performance. I got to say, elsewhere, T-Mobile, the earnings were okay, but those subscribers not living up to expectations. Really, what's hurting them this morning, John?
Danny, thank you. More from Danny later on in the programme. Let's get you some top stories on our radar this morning. China reiterating that it's not engaged in trade talks with the United States. The comments coming after President Trump said his administration is negotiating with China. An interview with the President of the United States just dropping across the wires. The President sitting down with Time.
Very interesting when it comes to Time and how they got to this reprieve. He's asked about, were you worried about the bond market and the stock market? I wasn't worried. He said that his advisor, Scott Bessent, Howard Lutnick, didn't tell me. He said, I did that. And then what made you decide? He said it wasn't for that reason. There wasn't a reason. I'm doing that until we come up with the numbers that I want to come up with, which begs the question, if these weren't the numbers you wanted, why did you come out with that chart on April 2nd on Liberation Day? I was there in the Rose Garden. Pomp and circumstance. Everyone was dressed up. There was music, flags. Then they started handing out the reciprocal tariff rates. And what did you see? Equity futures tank.
Initially, equity futures rallied because people thought we were going to have a baseline tariff of 10%. And then that little display came up with all these massive numbers, and we all said the same thing. What is this? So how quickly can we do something about this? The President, Lisa, saying we can announce deals over the next 3 to 4 weeks.
And that seems to be reflected by a lot of finance ministers who are here. But as we just heard from Sarah Bianchi, trade deals aren't exactly a, hey, let's do one. OK, great, we've done one, and here it is. So this is the challenge right now. How much does reality match the rhetoric? And what is going to take the temperature ultimately down between the 2 biggest economies, which is China and the United States, which is going to be difficult given that we don't actually know whether there has been a call between Xi Jinping and President Trump. He said, yes, he has called me. Xi Jinping and the authorities from China say there has not been a call. So the mystery will continue.
My favourite headline from this interview is this one right here. The President signalling some support for a ban on congressional stock trading. I think that a lot of people would support that as well. Why have we still not got that done in Washington?
Because you're asking members of Congress to ban themselves from trading. And it might sound like a good campaign idea, and then you get in the seat and you're like, actually, I don't want to be doing that. I have money in the stock market. I don't want to be doing that. But like you and I,
we follow stricter rules than them.
We have very strict rules. We cannot touch everyday trading. If you want to put your money somewhere, you do it blindly, basically. The president signaling that, I think will be interesting. Maybe they can get across the finish line.
Let's see if we can finally get this done. News elsewhere, Walmart doubling down on discounts, the company looking to drive demand and grow market share. Bloomberg learning the retailer is rolling out manager's special signs, calling out price cuts on key items, something you flagged a number of weeks ago, Lisa, and this is ultimately the direction of travel for this company.
They're going to invest in price, which basically meant they were going to absorb it on their margins to gain market share. The unintended consequence of some of this uncertainty is who has the most resilient balance sheets. It's the biggest companies. It's the ones that have the heft to go into places like China and negotiate. You also have Walmart coming out and saying that they're going to help local companies in China to actually circulate their goods. They're making themselves indispensable on both sides of the world.
this highlights how it just prolongs what we have seen over the pandemic and exacerbates it, which is smaller companies are going to have a much harder time than the big ones.
Who's going to have the inventory? That's another question for some of the bigger names as well. Clearly, they're worried about that in the coming weeks. Let's get you an update on the earnings. Alphabet reporting first quarter earnings that beat expectations, driven by strength in its search advertising business. It's a different story for Intel, delivering a weaker than expected outlook. Intel in the pre-market's down by 6.7%. Alphabet is up by close to 5%. Let's keep it on Alphabet and on Google. Scott Devitt of Wedbush raising his price target on the stock, citing optimism about Gen AI's impact on search. Scott joins us now for more. Scott, welcome to the programme, sir. Great to get your insight. I'm sure it's a busy morning for you and the team. I just want to understand what happened with the ad business, because this is a decent read on the broader economy. What stood out for you, and do you see the gains as sustainable through the rest of this quarter?
Good morning, Jonathan. So the ad business, or search specifically, outperformed expectations in the quarter by 100 basis points. So they did 10% top line growth for search, and that was really the overperformance from a revenue standpoint in the quarter. YouTube and the cloud business were in line. The company also overperformed in operating margin as well. And so I think, we've hit peak uncertainty for, the economy and companies like Alphabet, where you're now starting to check off boxes where, hey, this isn't as bad as we thought it could be. So you fast forward to kind of 2Q, the company doesn't give formal guidance, but gave qualitative guidance. And, our numbers, which had been below the street for 2Q, still are below where the street was, but not quite as much as it was before the call. And so I think net, this is a very positive report, especially given the stock was 200 3 months ago.
Scott, interested in the read across for Meta as well. And I guess the most important question there, one of the most important questions, is how the retailers are doing in the Asia Pacific, the kind of advertising they're doing at the moment, and whether you expect them to pull back anytime soon, given some of the restrictions we've seen come through.
Right. That's the one thing that stood out in the 2Q qualitative guide for Alphabet, which is that the de minimis exemption does go away, that will impact advertising spending by Chinese e-commerce companies from these U.S. advertising platforms. And Meta has more exposure than Alphabet. About 3.5% of its revenue comes from the Chinese e-commerce companies, and with Alphabet, it's under 2%. But I would anticipate that's going to be a headwind in the second quarter and really throughout the year. It's priced in, and it's now in expectations because it's pretty well advertised that that's coming. So I don't think it's new information, but it will proceed to be a headwind this quarter.
Scott, can we say that Alphabet is ultimately an advertising company, or has it shown enough progress with the cloud computing services, the number 3 in the industry, that you're growing more confident about the revenue stemming from that business?
I think you put it well. I mean, there are 3. There's room for 3, but they're a distant 3 in the category. 28% top line is healthy, but given the size of the business, in terms of absolute dollar volume growth, Azure and AWS continue to kind of run over GCP. So that's a good business, but the success of this company over the long term, and where the fears have risen more recently, have been around the AI impact on search. And quarter in, quarter out, Alphabet just continues to beat search expectations, is integrating AI into the search results and building out that business as well. And that's 2/3 of the business. This is a company now that trades at an S&P multiple, and we forecast the earnings growth rate for the next 5 years being 2x the S&P. So it's a very maturing tech company, but still a very well-positioned company, and one that we think is mispriced for that reason.
And Scott, part of this is not just the AI with respect to search. It's also the AI with cloud computing and how they're integrating it. And one thing that they doubled down on was the investment, the capital expenditures that they had committed to for cloud computing centers that a lot of people had called into question just based on the rhetoric that we've been hearing. And we'll hear more next week when we get a whole host of other big tech players reporting earnings. Do you think that the death of some of the AI boom, particularly in the infrastructure space, has been grossly exaggerated?
No doubt. I mean, you've had Alphabet now twice reaffirmed CapEx. Microsoft's reaffirmed. Amazon has said no real changes. NVIDIA's made commentary recently. Meta's made positive commentary. So this air pocket, or whether there was a natural air pocket approaching anyway, according to some, or the effects of tariffs and the economy on the business, it's not showing up in CapEx spending. Now, that doesn't necessarily mean there couldn't be impacts in terms of cloud growth because customers are pulling back a little bit in the short term. But in terms of the interest of these companies to continue to build ahead of this AI revolution, that was definitely affirmed in Alphabet's reaffirmation of the $75 billion last night.
Scott, we're all in Washington, D.C., and Google returned to Washington, D.C. earlier this week for a court case with the DOJ. How are you seeing this play out?
So there's two cases. One is, going directly at the search business, and I think that's probably the one that, to the extent that there was a negative outcome, would be more damning to the business. It's not one where we think it will be something where they have to do something like sell Chrome, but that's the one that we pay more attention to, because the second one, which is on ad tech, the ad tech business for Google's declined in revenue for 11 consecutive quarters. It's slightly more than 10% of revenue, but it's about a single-digit percentage of the profitability. You could extract that business, and the stock would probably perform positively on the back of that because it would remove an overhang related to antitrust. So I think the second case, the ad tech case, is a total non-event, and the one to pay attention to is the one related to search. And we'll just have to continue to monitor. It's not in the best interest of the U.S. government to really kneecap any of these large companies, given the battle that we're in with the large companies in China. And I think in the end, they'll come to that conclusion as well.
Hey, Scott, appreciate your time. Scott Devitt there of Wedbush. Alphabet doing better in the pre-market. That name is up by something like 5%. Equity futures more broadly down about 0.25% on the S&P. Moments ago, a release of an interview, the transcript between the President of the United States and Time, and an interesting exchange on a range of things, but importantly for a lot of you out there following markets, whether these talks with China and Xi Jinping have actually happened or not.
The president says yes. Xi Jinping has called, and he says, I don't think that's a sign of weakness on his behalf. So even if Xi Jinping, and now I feel like I'm gaming out something in the president's mind, but even if Xi Jinping has not called, the president is putting out there, yet once again, it is not a sign of weakness for you to pick up the phone and call me. Another interesting point. He's saying the fact that he thinks that basically where they are right now with the tariff rates is unsustainable. They won't do any business here. At 145%, it's going to be very rare that you see business. And this is what the Treasury Secretary said to me about a week ago, saying it's unsustainable. No one wants to see these rates stay this high.
Something Scott Besson has repeated time and time again. Equities right now down about 0.25% on the S&P with an update on stories elsewhere. Let's get an update with your Bloomberg brief and Yahara Hackers. Hey, Yahara.
Hi, John. Germany's finance minister says the best path forward for an EU-U.S. trade deal would be to eliminate tariffs on industrial products. He spoke to our own Lisa Abramowicz on the sidelines of the IMF meetings.
Of course, the devil is in the detail, and there's still a lot of topics that are open and that need to be ironed out. But there's a willingness on both sides to come to an agreement. At the end of the day, if it's generally the direction of travel were for tariffs to come down instead of go up, I think the markets would see that as a very positive signal.
Later today, Lisa will be hosting a panel with IMF First Deputy Managing Director Geeta Gopinath at 12:30 p.m. Eastern. Meanwhile, Japan is trying to strike a trade deal with the U.S. to avoid tariffs, but doesn't want to be part of a U.S.-led economic bloc against China. Sources telling Bloomberg Japan is pushing to strike a deal before the current 90-day reprieve expires. The country's lead trade negotiator is due to return to Washington soon for a second round of trade talks. And Apple is aiming to shift major parts of its supply chain out of China. Sources say the company is planning to make most of its U.S.-sold iPhones in India by the end of next year. That means Apple will need to roughly double its iPhone output in India. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later on in the program. Up next, boosting rate cut bets.
Wouldn't surprise me that you might start seeing more layoffs. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Governor Wally becoming a more and more important voice on the FOMC. In just a moment, we'll get the outlook from Mike McKee, who sat down with Governor Wally yesterday, and we'll get some reaction from Nathan Sheets of Citi. Live from Washington, this is Bloomberg. Live from Washington this morning. Good morning to you all. Equity futures on the S&P 500 shaping up as follows. Your scores into the weekend look like this. Down about 1/3%. Some losses building in the last 15 minutes or so, but nothing too dramatic relative to what we've seen to the upside over the previous 3 days on the S&P. On the Nasdaq 100, negative by about 0.4. Small caps underperform, down by 0.9. Other surveillance this morning, boosting rate cut bets.
Wouldn't surprise me that you might start seeing more layoffs, tick up in the unemployment rate going forward if the big tariffs in particular come back on. You might see layoffs start to happen about the same time you start seeing prices going up. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
So here's the latest. Traders raising their rate cut expectations following that conversation. Governor Chris Waller of the Federal Reserve sitting down with Bloomberg's Mike McKee, and Mike joins us now for more. Mike, fantastic exchange with a voice that is becoming increasingly important on the FOMC. From your perspective, following all the speeches and the commentary from the Federal Reserve over the past few weeks, is that Governor Waller speaking for Governor Waller, or do you think that reflects the consensus on the committee?
I think it's a little bit of both. Governor Waller speaking for Governor Waller, definitely. But the committee itself has, almost all of them have said the same thing, that if we see a deterioration in the labor market, we're probably going to have to cut rates. Now, the question is how much of a deterioration counts for each one of them. Chris Waller was saying, we'd have to move up fairly dramatically in order to get him on board. And he said we aren't going to have any data really to do that until after July 1st when the president's 90-day delay runs out. So I'm not sure it'll be quick in the sense of moving up into the time frame we're in now. But what he was saying was if we get that deterioration, then the Fed will move fast.
Mike, some people read speeches and look at exchanges like that one from Governor Chris Waller, and in the market at least, and I'll share the perspective on Wall Street, they look at that and they say he's running. He's putting some daylight between himself and Chairman Powell, and he's looking for that open seat on the committee in the next 12 months or so. Mike, what's your perspective, being close to the FOMC yourself? How do you think about that dynamic?
Well, I think there's definitely a dynamic at play there because everybody knows that one way or another, Jay Powell's not going to be chairman after May of next year. So there will be an opening for that. Now, Chris is already on the board, so he doesn't have to worry about getting nominated to the board first, like some other candidates would. But I asked him about it. He said, yes, there's maybe some daylight between me and Powell, but at the end of the day, we both do the right thing for the economy. I think he would probably take the job if it were offered to him because, of course, he's been doing central bank work for his whole career. And so it's kind of the pinnacle of the career path for him if it were to be offered.
I think it's fair to say he'd probably take that job. Mike McKee, thank you. Great work as always. More from Mike later on this morning. Here's the take on the economy. Nathan Sheets of Citi writing the following. We see global growth this year softening to 2.1%, down from under 3% last year. Given the trajectory of recent developments, the risks to our forecasts are skewed to the downside. Nathan joins us now for more. Nathan, good morning.
Good to be here.
How much has changed for you and the team in the last 4 months?
Oh, this is a completely different world. One, as you read, our view is that global growth this year and next year are both going to be much weaker. But even beyond that, it's deeply structural. And I think we felt that this week during the bank fund meetings. The U.S. has been the center of the system for decades. And now the U.S. is standing up and rejecting in very fundamental ways key features of the system. And I think the rest of the world is just kind of looking around and saying, what's next?
They're the near-term effects and they're the longer-term ramifications. In the near term, all of the finance ministers and central bankers are saying we need the dollar to be the reserve currency. How much do you expect that, though, to change longer term? And are they questioning that in private conversations with you?
I think that's one of the leading questions that I'm hearing is what about the dollar's role over the medium to long run as reserve currency? But even if we extrapolate out 5 to 10 years, it's still not clear that there are really any real challengers for the dollar in that role. And I think most say, well, we're kind of stuck with the dollar. But then the question comes, at what price? And I think that question of risk premium on U.S. assets is one that markets are struggling with as we speak.
Which goes to the question of weakness. And if there is some sort of downturn in the United States, what is the fiscal impulse and the ability for the United States to borrow into weakness at a time where we have near record deficits as a percentage of GDP and you have this structural shift going on?
If we have a downturn, and that is a very reasonable, plausible scenario, many people have that as their baseline forecast. If we have a downturn in the United States, the implications for the U.S. fiscal deficit are grim. We could be, again, easily knocking on the door of 10% fiscal deficits. And in that environment, do I think the Treasury can issue? I do. But again, at what price? What do those yields look like? What are the risk premiums? And I think that's the question we're going to be struggling with in the years ahead, is where is this risk premium going?
The president this morning speaking to Time magazine saying that he didn't get the yips. The bond market got the yips, but it wasn't the reason why he came out with that pause, even though everyone is saying that was the Trump put in action. Do you think that it is this bond market that is putting pressure up against this administration to come out and tweak and change policy?
I think the bond market has been front and center in this. I think it's the financial markets more broadly. But I also think it's the discussion with CEOs and what he's hearing. And I think it's political realities. I think there was a lot of pushback to this tariff policy. And I think the upshot of that is that we've officially now moved, it seems, from the phase of announcing tariffs to the phase of negotiating what these tariffs are ultimately going to look like. And maybe that's progress.
When it comes to China, the 145% is unsustainable. Everyone continues to say that. But even if we go to 60%, which was what the president talked about on the campaign trail, is that still, in essence, a trade embargo between Washington and Beijing?
145% tariff is prohibitive. And I argued during the election that a 60% tariff would be prohibitive. It would destroy many supply chains and mean a lot of shelves at various stores were empty. So absolutely, 60%, we're going to still see sharp declines in imports from China, with negative ramifications throughout the economy.
We've seen some pull forward, and certainly we've seen that in retail sales, and we're probably going to see that in inventories too. I want to understand from your perspective how much time we actually have here. It takes somewhere between 20 to 40 days to get a ship from China to the United States. Tariffs went on April 2nd. How close are we?
This is another issue that we're debating in real time. My view is that the second quarter is likely to be okay, that we've seen the soft data fall off, but the hard data are lagging, and they're going to continue to lag as people continue to front-load inventories and probably certain types of consumption. But the third and fourth quarter could be pretty ugly. I think that's the heart of darkness.
How convinced are you and the team that they'd respond quickly, the Federal Reserve being they, to any sign of weakness?
The Fed is in a very tough place here, where the bond market is equally focused, if not more focused, on what's going to happen with inflation. And so what the Fed has got to do is make sure that inflation expectations are well anchored. And once that's achieved, then they can pivot to rate cuts. And I do expect that by the end of the year, we'll be seeing rate cuts, but it could take us a few months, and it may not be at the first sign of weakness.
And that could mean a lot of pain in this market still to come.
It absolutely could.
Nathan, it's good to see you. Thank you, sir. Nathan Sheets there of Citi. Chairman Powell has basically made the point, Lisa, of suggesting that he is pledging to anchor inflation expectations. Governor Chris Waller was putting the emphasis elsewhere in the last 24 hours.
You're basically saying at the first sign of weakness in the labor market, then maybe we could take a shift. You know, Beth Hammack had the similar kind of commentary, so he's not alone in this. But how long is it going to take for that weakness to show up? And that's increasingly the question.
More on that story in just a moment. Equity futures on the S&P, bit softer here, negative by 0.5%. In the next hour of Bloomberg Surveillance, we'll catch up with Jason Thomas of Carlyle, the former Deputy Treasury Secretary Wally Adeyemo, the WeWork CEO John Santora, and the IIF President Tim Adams. That's all still to come from Washington. This is Bloomberg.
The outlook for markets are very, very uncertain.
All of this has been a disruption to the way America does business.
Companies are really good at adjusting. I would still bet on Fortress America from a corporation standpoint.
This is not the time to get out of the market, right? You need to play this out.
This too shall pass. And I'm still looking for the roaring 2020s to be a description of the entire decade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning to you all. For our audience worldwide, your scores this morning look like this on the S&P 500, following 3 days of gains on the S&P for the first time since April 2nd. Liberation Day. We pull back this Friday, going into the weekend. We're down 1/3% on the S&P. On the Nasdaq 100, we're down by 0.4. Lots of warnings this week from corporate America. American Airlines pulling their outlook. Southwest saying the industry is already in a recession. Some soothing numbers in the bond market, though. For the second consecutive week, bond yields are lower. That is good compared to where we were a number of weeks ago. Yields down again this morning by a basis point at the front end, down by 3 at the long end. The 10-year, 428.17. The rhetoric has improved. The policy hasn't changed too much. And for that reason, Torsten Slock of Apollo writes this morning. The consequence will be empty shelves in U.S. stores. Lisa, in just a few weeks.
This is the concern, and maybe this is what was expressed by some of the retail executives who came to Washington, D.C. before the pivot or a shift in tone. This idea that the pain has happened, you just haven't seen it yet. It takes a while for those container ships to get over to the United States. Here's the question. What is the end number that we're going to? Let's say we do get a ratcheting down of the 145% tariffs on China. As we just heard from Nathan Sheets of Citigroup, 50%, 60% is also prohibitive. So at what point will there be a whole rethink of the structure of tariffs as it's been laid out?
And that could potentially why we see this rhetoric coming out of the Oval Office. This morning in Time magazine, the president said Xi Jinping has called him. He wants to do a deal, also at 145%. These tariff rates are unsustainable, probably because those executives, like the Walmart executive, walked into the Oval Office and painted this apocalyptic picture ahead of back to school, ahead of holidays later this year. This is not something you want to do as you ran on trying to bring prices down. Groceries, gasoline, everyday goods for America.
Corporate America has had its say this week, that's for sure. You mentioned that meeting at the start of the week. The most important meeting that took place in Washington, D.C. this week so far. The pressure from the likes of Walmart, Home Depot and Target on the administration. I think we've got to deal with this up front. Where are we in talks? The Chinese have repeatedly over the last several days said there aren't any.
And today, the Chinese Foreign Ministry came out and said on no level are there negotiations, and that said that this administration is misleading the public. What I think you see the president doing is wish casting, because potentially what he's saying, and he said to Time magazine, is it wouldn't look weak, Xi Jinping, for him to call me. So maybe he's trying to insinuate and tease out there, Xi Jinping, I'm available. Pick up the phone.
The president attempted to dial down the temperature this week. That's helped out equity markets. This morning we pulled back just a touch. We're down 1/3%. Coming up this hour, we'll catch up with Jason Thomas of Carlyle, with stocks looking for a fourth day of gains. We'll speak to the WeWork CEO, John Santora, on business confidence in America, and the IIF President, Tim Adams, on the latest with US-China trade talks. We begin this hour with this week's rally on hold as China downplays progress in trade negotiations. Jason Thomas of Carlyle writing, if Treasury yields do not decline when stocks sell off, investors may discover they've been paying for a hedge that no longer works. Jason joins us now for more. Jason, good morning. Good to see you.
Good to see you. Thanks for having me.
I'm pleased you've picked up on that piece because I want to pick up on it with you as well. This EM-type dynamic that started to take hold of US assets, dollar-denominated assets, what's behind it, one, and do you think it's sustainable, two?
Well, I think, first of all, we have to remember that bonds are volatile in a way that cash is not. So at the start of this month, if you had $100 invested in money markets, it was yielding 4.3%. The 10-year Treasury at the time, 4%. A week later, the cash was still at par, as it always is. The bond was down to 96. And so in the past, there's generally been, of course, a term premium to compensate for the volatility. That went away in the decade after the GFC. Why? Because any time there was a hint of weakness in the economy, anytime there was a decline in stocks, the Fed would launch another round of QE, with, of course, the intention of driving down bond yields. So, of course, there were many risk parity strategies. You had investors who were hedging their stock market risk through leveraged positions in bonds. That worked very well. Some years, stocks down 12%, those leveraged bond positions up 15%. Now, I think we're in a somewhat different world. Partly, of course, that's the external sector wondering about being over-allocated to the U.S. That's stocks, that's bonds, I think more broadly. The deficit, when you think about how large the deficit is, this year, Treasury net issuance is consuming over 42% of U.S. private savings. That is the savings of the household sector, the free cash flow of the corporate sector. So if this is not going to be financed in large part by external investors, you have to wonder what the market clearing interest rate is going to be. So I think that what we're seeing is that if there is not this hedge, if treasuries do not predictably rise when stocks fall, then there has to be a much larger risk premium on bonds relative to cash. And if you look historically, the 1980s, 1990s, that was in the range of about 150 basis points.
So it feels like that process is underway. We're working our way through it. Without doubt, you can see it on the screen in the price action of the last several weeks. I want to understand from your perspective how investors should now manage that risk. They've got very used to having this ballast in the portfolio that treasuries typically provide. Where do you go now?
Well, of course, I would recommend that people go to private assets, particularly private credit. But I think that the general portfolio thoughts have to be reexamined. There's talks of a 50-30-20 portfolio. But in general, it's that what worked so well in that decade after the GFC is not going to work today. So whatever your solution is, there needs to be a rethink. And I think that, again, it's been so ingrained that treasuries are supposed to rise in value when stocks fall. There's no mathematical law that's supposed to occur. And again, the return correlation with stocks and bonds was positive in the 1980s and 1990s. So this is not entirely new.
Yeah, there is a larger consequence here, though. I'm thinking through as you're saying this, and if you're talking about a clearing price that's different for treasuries to account for that additional risk premium, we could be talking about 5.5% on 10-year treasuries pretty easily based on your calculations, which would have a massive effect on private asset valuations, which would have a massive effect on stock valuations, which just kind of really speaks to this question of whether it's a sell America trade.
Well, I think that, again, if I were thinking about exposure today, it would be short duration. I see a lot of duration risk in the market. And I think generally investors have not had to worry about duration risk. It's again, the mindset is whenever we get into trouble, there's going to be another round of QE, and they're going to drive down longer-term yields. Now we're in a situation where those prices could move in the opposite direction, and that actually compounds losses. I think that the issue right now also, the Treasury is funding 22% of the outstanding stock of debt in the bill market, in the money market. There's of course, a desire to term that out, but there's, of course, a hesitancy. We want to wait for the right time. I think people were hoping that the 10-year would fall below 4%. Then let's term out some of that debt. And by waiting, they might be in a situation where they have to term it out at much higher yields. So it's certainly a concern. And I think, as was mentioned earlier, if you do have a downturn, if you have a decline in tax receipts, if you have an increase in transfer payments, just the scale of debt issuance, and now go from 40% to 50 or 60% of private savings being consumed. So again, I think it's taking the short-term assets. Sometimes the credit spread on that is less risky than the duration spread of holding longer dated assets.
Has this dynamic removed a lot of the power from the Federal Reserve to really address downturns? And I say this at a time where potentially if they drop rates right now, that will only lead to a furthering of this trend of yields in the long end going up.
It's a great point, but we have to remember the Fed is an extremely dovish institution. I mean, and of course they say that's because of the dual mandate. But I mean, think about 1998. The U.S. economy in real terms growing at 4%, employment to population ratios at all-time highs, the enthusiasm of the stock market. This is 2 years removed from Alan Greenspan's irrational exuberance speech. And they cut rates by 75 basis points because the hedge fund failed. When you think about 2020, the way they did the autopsy of the last 10 years and the statement for policy goals going forward, they said the big mistake in the decade of record monetary accommodation was hiking too fast in 2015. So the Fed is going to cut this year. I mean, it's funny that this is like controversial or, the Fed's in a box. The Fed is going to cut and likely by September.
But how much has the pandemic actually hit them hard in terms of wanting to make that mistake again? Governor Waller said that to Mike McKee, that idea of being transient. He's even nervous to say that word out loud.
I think that this is what Chair Powell has made clear is they can't do preemptive cuts. They have to wait. They have to see.
Didn't they preemptively cut before the election?
Well, I think there was certainly a strong case for rate cuts in September. Now, whether they needed to cut by 100 basis points in just over 3 months, again, this is sort of the dovish nature of the institution coming to the fore. But I think that this is a situation where if you are cutting as tariffs are first taking effect in terms of the increase in the price level, you could accommodate a spiral. So they have to wait. But we're talking about waiting a couple of months. This isn't really, an elongated pause or anything of that sort.
You've said a lot of things that require some real deep thought. There's one thing that scares me. Typically in an economic downturn, bonds rally. And that allows a government to act countercyclically. A developed market government, EM, of course, face a very different dynamic. Are you saying that if we go into a downturn, the long end doesn't rally?
I think that the rally is going to be muted. And so, again, if we think, I think the Fed will be more cautious this time, of course. But imagine that we have base rates in the 365 range. Well, these yields actually might be appropriate given the risk premium, the term premium that is required. Maybe you get down to something closer to 4%. But again, I think that the important thing as investors think about the next 5 years is that if bonds do not rally in this scenario, that on a prospective basis, when the economy recovers, that they're going to need to target much higher yields, that compensation for the bond price volatility that doesn't exist in cash.
Jason, this is an important exercise, and I'm pleased you dropped by this morning.
Thanks so much for having me.
Thanks for being here. Jason Thomas there of Carlyle. Just to touch base with your bond market right now, we're doing okay. Yields are down by 2 or 3 basis points. 420, 430 on 10s is where we've been over the last few weeks or so. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahira Hackers. Hey, Yahira.
Hi, John. The U.S. is said to be demanding that Russia accept Ukraine's right to develop its own army and defense industry as part of any peace agreement. Sources say U.S. envoy Steve Witkoff will travel to Russia to raise the issue with President Putin. It's a sign the Trump administration is seeking some concessions from the Kremlin, as well as Ukraine, as it tries to end the war. Meanwhile, Skechers shares are falling more than 7% in the pre-market after the company withdrew its full-year outlook. The shoemaker cited macroeconomic uncertainty stemming from global trade policies. According to regulatory filings, Skechers, like many other shoemakers, makes a significant portion of its footwear in China and Vietnam. And Alphabet shares are rising 5% in the pre-market after reporting better than expected earnings. Interestingly, the company said its first quarter profit got an $8 billion boost in unrealized gains from an investment in a private company. Sources tell us that company is Elon Musk's SpaceX. Google has been a major investor in SpaceX since at least 2015. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira later on this hour. Up next on the program, conflicting reports on trade talks.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is.
We're trying to attempt to find out who they actually is. We'll catch up with the former Deputy Treasury Secretary, Wally Adeyemo, in just a moment. Live from Washington, D.C. You're watching Bloomberg TV. Equity futures on the S&P 500 just a little bit softer so far this morning, following a 3-day run of gains on the S&P 500. Under surveillance this morning, conflicting reports on trade talks.
Can you clarify with whom the U.S. is speaking with China? They're saying it's fake news that trade talks are happening.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
So here's the latest this morning. China continuing to deny trade talks with the United States, even as President Trump says negotiations are ongoing. A little bit more insight into the president's thinking in the last few hours and a new interview with Time magazine. With the latest on that front, Bloomberg's Tyler Kendall joins us now for more. Hey, Tyler.
Yeah, hey, John. Well, this new interview with Time magazine was released today but conducted back on Tuesday. And in it, President Trump contends that he has no plans to call Xi Jinping if the Chinese leader doesn't pick up the phone and call him first. But at the same time, he suggested that Xi has phoned him, although he did not give a timeline on exactly when. And it's probably worth saying that, of course, these leaders have had calls before, most recently right ahead of the inauguration. Now, President Trump, though, did reiterate that he thinks the 145% levy on Chinese goods goods is very high, amounts to a trade embargo, and suggested that he knows the tariff rate that Beijing would be more comfortable with seeing. It comes after our Bloomberg News reporting this morning that China is preparing to potentially exempt some U.S. goods from tariffs, including those industries that are more import reliant, including medical devices as well as industrial chemicals, in a bid for Beijing to protect its own economy. Of course, we're talking here about the disconnect between Beijing and Washington, particularly when it comes to where talks currently are situated. But President Trump in this interview did say when it comes to other talks, other trade deals, we could expect to see those in the next 3 to 4 weeks. Although earlier this week, he told us that we could expect to see revised tariff rates in the next 2 to 3 weeks. So clear that the timeline here is, of course, very fluid. And, of course, we still don't have details on exactly what we will end up seeing. And, John, I will quickly leave you with this. One thing that President Trump did say in this interview, when asked if higher tariff rates were still in place 1 year from now, would that be considered a victory? He responded that it would be a, quote, total victory.
Tyler Kendall with the latest from the White House. Tyler, thank you. Here's a take from a man who's seen it all, the former Deputy Treasury Secretary Wally Adeyemo, writing, the only way we can address the China problem is by working with other countries. But for many of them, they're still waiting to hear what the US even wants. Wally joins us now for more. Wally, good morning, sir. It's good to see you.
Good to see you here. Thanks for coming to Washington, D.C.
You've been in the room with the Chinese many times. How difficult is it to negotiate with them? Just set the scene. What is it like?
The reality for the Chinese is they are very systematic in trying to find your weaknesses by both talking to you directly, but also talking around you to other people. So when you are negotiating with the Chinese, you have to be very clear about what you want. You have to repeat it over and over. You need to tell your friends and your allies in the hopes that you'll get 50% of what you want in that conversation. And it's always about how do you make progress rather than perfection with the Chinese.
You referred to the China problem. What is the problem? And what do you make of the approach so far?
The reality is, and over the course of this week, in addition to getting to see you, I've gotten to see a number of my former counterparts. And the thing you've heard from our closest allies is just disappointment, because they all face the same challenge, which is that China takes steps to subsidize their industries and export excess capacity to the world. And the challenge we have in the United States is the same challenge they have in Europe, is the same challenge they have in parts of Southeast Asia. And for many of them, they want to work with us to address this, because if the U.S. blocks Chinese goods from coming to America, the people today who are afraid those goods are going to show up on their shores are in Southeast Asia and in Europe, and they now need to think through what are they going to do to deal with China's excess capacity that's coming in their direction.
Let's look at Europe. Are they speaking with one voice? We had the Spanish finance minister in the room here yesterday, and John picked up on something he said. He called China an ally, and we have seen the Prime Minister, Pedro Sanchez, go to Beijing 3 times in the past 2 years. It feels like they're placating to China and actually not coming on board with the United States.
So I think you're right. That's part of the challenge, is that Europe doesn't speak with one voice, because today, if Europe did speak with one voice, they'd be in a better position to negotiate terms. Europe is the 3rd largest economy in the world. If they were willing to work together to do things like put in place the free trade agreement they have with other countries, and to go and work with the TPP countries, they'd have the ability to dictate more terms. But today, because they're unwilling to, they're caught between China and the U.S., and that's the most important thing for the Chinese. They're concerned that if they don't find a way to dial back this, they're going to end up in a place where countries like Europe or regions like Europe or other countries will choose the U.S. over them. But unfortunately, the approach the Trump administration has taken has, instead of bringing Europe closer to us, put them in a place where they're up for debate. And you hear things like that from the Spanish in terms of, are we allies with the U.S.? Are we allies with China?
And then Rachel Reeves in the UK and along the sidelines of the IMF is saying things like, Trump is right. China does need to rebalance their economy. How difficult was it for you and Treasury Secretary Janet Yellen to get that message across to China? You have to start rebalancing your economy.
And this is not a new message. Secretary Paulson sent it to the Chinese, Secretary Geithner, Secretary Liu, Secretary Yellen, and I know that the current secretary is sending it as well. The truth is that China is only going to respond if they feel pressure, and it's not just going to be from the United States. They've got to feel it from the UK, they have to feel it from Europe, and the best way to do that is to work together to confront the Chinese. Today, the Chinese feel empowered because instead of being confronted by the world who's suffering from their excess capacity, the United States in lots of ways has alienated the world. The hope over the next few weeks is that Secretary Bessent and the President are going to be able to work with our allies and partners to find an approach that works, because the people who are going to suffer most from this are American consumers. You could see their bills go up by $3,000, and that's not just a statistic. You heard all of the CEOs who've been doing earning calls who have said that they're going to have to raise prices. And they've all said that they had great first quarters because the economy is doing quite well. So we're in a place right now where if the United States doesn't get into a posture of working with our allies and partners and reducing these tariff rates, I can't guarantee that we're going to have a recession, but I can say that prices are going to go up for American consumers.
Is it too late to really create that alliance and go after China? Has China already made inroads in terms of making alliances, whether it's with the Spains of the world or even in Southeast Asia?
So the interesting thing I've heard over the course of the last few days here is that people are equally as nervous of American tariffs as they are of Chinese excess capacity. So the people who live in Southeast Asia, the people in Europe, are worried that all those goods that were headed to the United States that were hurting our industrial base are heading to a port near you, and that China's excess capacity is going to overwhelm them. So I don't think it's too late, but our allies and partners are going to be more cautious about dealing with us. But the reason that countries are coming to the United States is because they want to make sure that their industries and their countries aren't overwhelmed by Chinese overcapacity either. So there is an opportunity here, but it's not one that's going to be open forever. And the Chinese are working hard to try and counter that. President Xi's visit was all about trying to buttress their ability to have allies and partners as the U.S. confronts them. But Vietnam, in addition to gaining a great deal of economic value from their relationship with China, has to be worried about Chinese excess capacity showing up there as well.
There was a story in the Financial Times and on Bloomberg about how Apple was moving all of its iPhone production away from China into India. Hopefully by the end of next year, this hopefully for them, that is the projection they put out there. Is that how this is going to work from what you hear, that essentially India is going to be the big beneficiary from a lot of the tariffs, particularly on China?
That's how it's worked the entire time. Since basically the Obama administration, a number of companies have been moving to a China plus one strategy where they build for China in China and they build for everybody else somewhere else. That's been Vietnam, Malaysia, India. But the problem has been Chinese companies have taken a China plus one strategy too. They've moved away from the tariffs they put in China by setting up shops in Vietnam, Malaysia, and probably now in India too. That's why we have to work with these countries, because the Chinese are being very clever about this. They see the huge tariffs that are being placed on them in China, so they're setting up shop. And my understanding is that a big part of the negotiations with Mexico and Canada is around making sure that Chinese firms can't set up plants in Mexico. Ultimately, I think that they should be able to get to a deal with Mexico and Canada because we're such an integrated economy, but it's going to be harder to get to those kind of deals with countries that are closer to China.
Wally, I've got 30 seconds left. Is there anything you wish you'd done differently with regards to this topic?
I think the reality is that the thing you always hope that you could do is get to a deal with your allies and partners to confront the Chinese. But the other thing that I think is clear is that tariffs work when you use them strategically. They don't work when you use them in a broad-based way, because what that does is it causes more pain for your consumers and your allies. And the thing that's worried me a great deal is talking to asset allocators around the world. And for each one of them, they've been overweight the United States for a long time because of the exceptionalism of our economy. But today, each one is talking about reallocating their assets. Hard to find other places to do that in the short term. But if over the long term we don't provide clarity and certainty, the things the American economy has done over the last decades, I do worry about our ability to attract capital into the United States.
Wally, it's good to see you, sir.
Great to see you.
Thanks for being with us. Lots to talk about, particularly the deficit. Got to talk about that with Wally at another time. The former Deputy Treasury Secretary, Wally Adeyemo. From New York, this is Bloomberg. As of Thursday at the close, we're heading towards a decent week of gains on the S&P 500, even with losses. Monday morning of more than 2% into the close on Monday, the first trading day of the week. We're still higher on the week by 3.8% on the S&P, thanks to the rally over the previous 3 days. Elsewhere on the Nasdaq, we're negative by about 0.1% this morning. On the Russell, we're down by 0.75% with some morning movers. Let's cross over to New York and get the latest with Danny Berger. Hey, Danny.
Hey, John. Some much welcome relief, I am sure, for Google investors. A really solid set of results. Their search business outperforming, really leading the results higher. You also had cloud services doing well thanks to all of the AI demand. In fact, their capital expenditure managers were higher than expected, saying the demand we don't have enough data center capacity to keep up with it. So those shares up about 4.75%. To the other side of things, though, a very different story for Intel when it comes to tech earnings. Also reporting after the close a disappointing outlook for Intel. They are also cutting CapEx and cutting their staff. Those shares down 7%. The new CEO, his first set of results, giving wafer-thin expectations for what's to come for this company. So disappointing one on their part. Also to the downside after their earnings post-close is Gilead. This is the drug company. They had disappointing results in sales for some of their key blockbuster drugs, things that treat breast cancer and HIV. For example, those shares down nearly 4%. One interesting little nugget in their earnings, too. They said that their forecast would have been higher. However, they had to write it down because of increased costs due to tariffs on things that are impacting the price of stuff like lab supplies and raw materials. John.
Danny, thank you. We've seen that movie a few times so far this week from corporate America, that's for sure. On our radar this morning, President Trump continuing to say the U.S. is holding trade talks with China. China denying there are any negotiations and saying the U.S. should not mislead the public, something China's said now repeatedly for the last few days.
But the president continues to double down. Yesterday, he said there was a meeting, they had a meeting, and then when the Reuters reporter said, who are you talking about when you say they, he said, maybe we'll disclose that, maybe we won't. It's not on brand for this president to not disclose who the meeting is with. So it does feel like the negotiations are not taking place. But then a Time magazine this morning interview, the president said that Xi Jinping, he called him. One thing that is clear, whether or not the calls are taking place or not, the president doesn't want the tariffs to stay at 145%. He thinks that's unsustainable. So the direction of travel is lower.
At the same time, scenario analysis is going to be important, not just at the Fed, but also for a lot of companies. If it's 60%, is that sustainable? 50%? At what point can you start shipping goods back over? This is going to increasingly be the path of travel for conversation.
We're seeing changes. Lisa, you mentioned this story just moments ago that Apple's aiming to shift its supply chain out of China, at least some of it. Sources telling Bloomberg the company is planning to make most of its US-sold iPhones in India by the end of next year. Lisa, that shift is happening.
Yeah, and this is fascinating at a time when Apple has doubled down for years in China to build up some of its factory capacity and has a huge presence there, both as a manufacturer as well as a producer in the mainland of China. A question here, A, whether this is feasible, because this is actually a pretty big shift in such a short period of time. And then B, is this okay? We were supposed to have all the people on Wall Street making iPhones. Remember all those memes where people were sitting next to each other, quickly doing this? Is it really just going to go to India? And is that really okay with this administration?
Dan Ives was trying to make it happen in New Jersey, wasn't he? Apple's down in the pre-market by 0.9%. Let's keep it on tech. Amazon, Nvidia, saying demand for AI data centers remains robust. According to reports, executives from both companies dismissing reports that recession fears are slowing demand. Look at these moves over the last week. Lisa, Amazon up by 8%, Nvidia up by close to 5%.
I wonder how much of the story of the rebound isn't just the sense that there is more conciliatory tones from Washington, D.C., but the tech story. That actually these investments are still happening and that maybe some of the fears of the AI trade and that sort of key piece of U.S. exceptionalism isn't as dead as people had previously expected. What you saw was higher than expected outlooks for fiscal capital spending for the likes of Alphabet. If you see that reiterated by the others that report next week, how much does that do to this trade?
A lot of Max 7 reports in the next week or so, including from Apple. Elsewhere, it's been very mixed for earnings so far this week. Large corporations from Pepsi to P&G cutting their outlooks due to Trump's tariff policy. One company, however, thinks they'll benefit from the uncertainty. WeWork, which provides co-working spaces for companies and individuals, is hoping that market risk will help it bounce back from bankruptcy. Joining us now is the WeWork CEO, John Santora. John, it's good to see you, sir. Thanks for being with us.
Good morning, John.
Give me the strategic update. What is the strategy now and how has it changed in this certain period for the company compared to a very uncertain period for the company a number of years ago?
So where WeWork stands today, we're a maturing company. We're a company that has no debt. We're investing in our portfolio around the world. We're investing in our members and our people. So it's a very different place today than it has been in the past.
Does it rely on a different kind of business?
Our business is flexibility, right? It's to be able to provide from 1 to 1,000 seats for companies, for the entrepreneurs. That's always been a part of our business, right? It's about 27% of our business. Then you have the small and mid-sized companies, 50 people, 100 people. And then you have that whole enterprise platform that we have, which has been really growing the last year or so.
Are you finding those changes are coming because of what developed during the pandemic coming out the other side? Is that what forced the issue for the larger enterprises?
I think if you look historically during different markets, right? There's always that downturn. There's always that need to sublease space. We always take too much space in good times. We get rid of too much space in bad times. We fill that gap. So giving them 20 or 25% of their portfolio that's flexible, increase it, decrease it without taking the hit to your books, without writing off that space and writing off all the capital, and being able to provide that flexibility in markets around the world is key.
So where are we right now with respect to the uncertainty that we hear from corporate executives around the country? Is this a time where they want to ramp up their flexibility and increase their footprint with you, or pull it back because they actually see that as a lever that they can pull without being seen too much?
This is a time, any pause, a recession, whatever, is not good for any company, right? For us, our clients are saying, with the pause, I'm not sure if I'm going to take more space. I'm not sure if I'm going to cut back. They pretty much are pausing with us, and that doesn't cost them anything, right? They stay in our spaces. They'll move. They'll adapt in different markets. You talked about India earlier on the show. We're seeing a big move out to India with our clients. All the big banks, all the financial institutions are growing their presence in India. The clients, you mentioned Apple and so forth. They're all looking to take more space in India. But are they going to take 10 and 15-year leases with the uncertainty of what's going on in the market? They'll look to a player like us to give them that flexibility.
Just to be clear, are you seeing stasis when it comes to leasing right now, or are you seeing leases increase in places like India and decrease in places that previously have been popular? I'm wondering whether it's even some of the Northeast cities.
I think it's a little too early to tell what the long-term effect will be. But, in discussions with CEOs and CFOs, are you willing to make that 15-year commitment to a market today with the uncertainty? You have to pause. You have to think about it. You have to think whether or not to invest that major capital in a market, at least for this short term. You have to step back.
In the go-go days of WeWork, I remember that every time a building was getting rebranded, it was going to be a WeWork. When I was walking around the city, there was just this massive expansion plan. And then there was a retrenchment. Are you back in expansion plan? Are you looking for acquisitions in terms of properties, or are you kind of happy with your footprint and just expanding in other ways?
Yeah, we have a really good footprint now. It's been restructured. We're in the markets we want to be in. We're in the markets that our members want to be. We're in the right product. Over time, though, for the first time in the history of the company, we're going through a traditional lease expiration. So we'll look to upgrade in some markets. We may look to leave a market, but that's going to be a rare case. We like the markets that we're in. So we're going to do some upgrades here and there.
During the pandemic, we saw a number of companies move from New York to Florida. Are you seeing companies still leave New York?
And I've grounded in real estate and grounded pretty much in New York real estate, where I've always lived in New York and always worked out in New York. The New York market is it's the capital of the world, right? It's the capital of finance. It's the capital of most companies. Their headquarters are there. A lot of companies, their headquarters are there. It will always have a presence. It will always be important. There'll always be headquarters there. There'll be some changes, though, over time. People will adapt.
When it comes to new markets, though, across the U.S., are you seeing more of a buildup?
No, we're not.
Midwest, West Coast?
Yeah, we're not seeing that much. We're seeing markets start to return. I was in San Francisco 3 times so far this year, and we're seeing that market start to return. We're seeing people on the street. We're seeing buildings start to fill up.
They finally cleaned up that city. Are you happy with progress?
They've made progress. They've definitely made progress.
What needs to change there? How do they fix this mess?
I think part of it is, it's security, it's safety, right? People need to feel safe when they're going to work. They need to feel safe as they're walking the streets. They need to feel safe on the subways and the transit systems.
John, it's good to see you, sir.
Great.
Thanks for being with us. Thanks for dropping by.
Having me.
John Santora there, the WeWork CEO, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. South Korea says it's reached an understanding with the U.S. to prepare a trade package before July, when President Trump's 90-day tariff pause is due to end. The comments came after U.S. Treasury Secretary Scott Bessent said yesterday he expected an agreement of understanding on trade with South Korea as soon as next week. Meanwhile, Nintendo shares rose more than 3.5% in Japanese trading today as pre-orders for its Switch 2 console sold out at several stores in the U.S. Orders for the $450 device are no longer available on the Walmart, Best Buy, and Target websites. The console will be released on June 5th. And a 19-year-old man has been arrested and charged with arson in connection with a New Jersey wildfire that could become the largest in the state since 2007. Authorities say the man set a bonfire and left without fully extinguishing the blaze, sparking the quick-moving wildfire. It is partially contained and no deaths or loss of homes have been reported. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, pushing China to rebalance.
You'll be meeting with your Chinese counterparts. How will you help them understand that it's not just about talking, it's about executing?
There is an opportunity for a big deal here. Let's do it together. This is an incredible opportunity.
That was the Treasury Secretary, Scott Bessent, sitting down with the IIF President and CEO, Tim Adams. We'll catch up with Tim in just a moment. From Washington, D.C., you're watching Bloomberg TV. Equity futures on the S&P 500 shaping up as follows. On the week so far, poised for a week of gains on the S&P, up about 3.8% on the week so far. This morning, futures lower by 0.3%, but lots of bullish commentary. Julian Emanuel of Evercore earlier in the week saying our base case is the lows of this sell-off have been seen. Bianchi charter at Deutsche Bank now targeting 61.50 year-end on the S&P. That's down from 7K, but saying this, that the base case remains for a significant rally on a credible relent on trade policies, and that credible relent likely needs a significant decline in approval ratings, which begs the question how much pain we need to see before we get there. In the bond market, 2-year, 10-year, 30-year, certainly some better news in fixed income over the previous 2 weeks, including this one. Yields down for a second consecutive week, yields lower for a fourth consecutive day. We're down by 3 basis points on a 10-year to 4.28. On 30s, we're down 4 to 4.73.68. Under surveillance this morning, pushing China to rebalance.
You'll be meeting with your Chinese counterparts. How will you help them understand that it's not just about talking, it's about executing?
There is an opportunity for a big deal here. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, let's do it together. This is an incredible opportunity.
So here's the latest this morning. The U.S. calling it a big opportunity, but Beijing denying White House claims that talks for a trade deal are even underway. Joining us now, the man who sat alongside the Treasury Secretary, Scott Bessent, the IIF President and CEO, Tim Adams. Tim, it's good to catch up with you, sir.
Good morning, everyone. Thanks for having me.
Thanks for being here. What did you make from the address and the approach of the Treasury Secretary earlier this week?
Well, I think this was Scott Bessent's breakout week. I think he really established himself as the sober voice of reason in this administration, and boy, they need one, and I think he's the guy. And I think he did a very good job of articulating where this administration wants to go. But importantly, this week, he said they want to stay anchored in the Bretton Woods system. That's really important. It was a collective sigh of relief across this town.
When you've spoken to financial executives, policymakers, finance ministers throughout the week, are they clear on what the demands are now? Do they walk away from Washington going into the weekend knowing what the ask is?
No. And it could change, even if you did know. I think everyone wants to see Scott. I think they understand the secretary's at the epicenter of really rational thought. And if you want a reasonable answer, he's the person to see. But they just want some certainty. They want to know, where do you want to take this discussion, whether it's trade with China or whether it's broader tariff issues. They just want some idea of what's the trajectory look like.
April 2nd was a shock to many. Yeah. Just the scale of the tariffs, the reciprocal tariffs. We've had the policy shock. We've talked about it being potentially a shock to the system, not just a shock to the cycle. Does it have the potential to morph into a financial shock in the months and years to come?
It does, but it's the real economy shock that's yet to come. You see the soft indicators have all indicated that there's concern. The real indicators haven't shown that yet. I think a lot of there's early inventory stocking. That's the second half of the year, but it will come. And the markets really matter this administration. The president sort of downplayed the bond market and equity market. It matters, I can assure you.
Well, and this raises a question for the banks, the institutions that you talk with on a regular basis. How concerned were they at the prospect that we might have gotten some dysfunction in the Treasury market if there hadn't been the pivot from the White House, and what that means for their safe assets, for their portfolios, for market functioning going forward?
Well, they feel pretty good about the way markets function. So there was another sigh of relief. And the institutions, the banks I represent, have plenty of capital liquidity, and the markets actually function well. The question is, where do we go from here? And especially if you have an economic downturn, we see a blowout in deficits. We're running deficits 6% of GDP. They're going to go higher if the economy, the cycle turns. So the question is, what does the future look like? I'm not worried about financial stability per se. I'm worried about fiscal sustainability.
There is a theory that this government could reduce some of the regulations around the liquidity provisions and how banks have to hold them, and basically allowing them to invest more heavily in U.S. Treasuries, which could alleviate some of these concerns. Do you see that as coming to the fore in the near future?
I don't think in the near future. I think this administration is looking at a broad range of financial regulation, and the Secretary said he's going to direct that. What I did hear from regulators around the world here this week is a sense that the globe needs growth. We need global growth. And regulators need to think about all that they've done over the last 15 years. And did it really make the system stronger? I think it did. But did they go too far? And do we need to focus on capital formation, risk-taking, and economic growth? And I think that's something new I heard this week.
What's interesting is that this is one of the pillars of the whole financial bet at the outset of the Trump presidency. People truly believed that this would be a deregulatory regime, and it would boost the traditional banking system in a dramatic way, at least from a profitability standpoint. Is that offsetting some of the pessimism around growth and actually maintaining this sort of feeling of optimism among the financial institutions you talk with?
You know, their animal spirits are always there in the United States, and that's what's, we should celebrate that. Right now they're dampened a bit just out of uncertainty. I think deregulation is going to help. I think they're serious about that. We just need to get some fiscal sustainability, and we just need to move beyond the tariffs and trade dislocation, because that's really weighing on the markets.
The Treasury Secretary is dying to move beyond tariffs. He wants to go to the tax bill. Do you think this administration can really get anything more done than the extension of current policy?
Well, he's certainly trying. Now, you need a team in place. You need bodies in the buildings to actually negotiate all these trade deals. I think he himself, Scott Bessent, he's got a tax bill, he's got trade bills, he's trying to watch the markets, he's on an airplane, he was in Argentina, which you know well. I think he's trying to do quite a bit. Thank goodness he's there. And I think left to his own devices, he'll get us a long way. But we do have a historic tax bill that needs to get negotiated.
When you say thank goodness he's there, and the Chinese come out and say, or at least we've reported that they are looking for a point person, is that who they want to negotiate with?
That's who they want. That's who you want. I worked for Hank Paulson. We started the Strategic Economic Dialogue. We've been talking about China, U.S.-China imbalances for 20 years, if not longer. It's time to really do a deep dive and address these in a practical, rational way. I think Scott can do that.
He said to you, as similar to what he said to me, it's like Fantasia, the Disney movie. It's a broom and a bucket. It just keeps circular economy when it comes to China. Can the U.S. do this alone, or does it need Europe and Southeast Asia to also confront China?
Well, it's possible to do it alone, but you don't want to do it alone. Alliances really matter, and I think other countries suffer from the same set of concerns that the United States does. Build those alliances. We've been talking about it for years. I think they're willing. But you've got to incentivize them, not just with sticks, but with carrots.
There's something key you asked the Treasury Secretary. You led him. You said you're going to be meeting your Chinese counterparts. He just kept talking about China's imbalances in their economy. Has he met his Chinese counterparts this week?
I don't know if he has, but he should. It would be improper if he doesn't actually see them. But that's where the negotiations start. And the challenge with China is there are lots of officials. Ultimately, Xi Jinping's got to make some serious decisions about how they rebalance that economy. But the Secretary can be the principal point person for this administration.
Forgive me for going into the realm of speculation and gossip, but what do you make of the situation we're currently in, where the White House is saying these talks are happening and China is denying they're ever taking place?
Oh, there's so much noise out there. So you got to look for the signal. I just look for someone like...
What do you think the signal is?
I think the signal is that they do want to have this discussion. I think the president wants to be seen as the Chinese coming to him rather than him going to them. Let's just get beyond the antics and get down to brass tacks. We need to negotiate this. Markets are looking for certainty. They're looking for direction.
They're always looking for that. One thing that we've been looking for decades is for China to rebalance. And you've touched on this issue several times. You've worked on the issue. Other people have worked on the issue.
Yeah.
What are the lessons of the mistakes that we've made over the last several decades in this country that we can correct under this administration to push China to finally rebalance?
Should have been tougher 20 years ago. We talked about it. We were engaged. I spent, countless trips flying back and forth. We should have been tougher. I think there were many in China and Beijing who wanted to do the right thing. I think they understand they've gotten themselves in a precarious position. I think they want to rebalance. But rebalancing that economy is incredibly difficult. I think we have a golden moment now to resolve this. But we need our allies there. We need Japan and South Korea and Europe and Australia. We need everyone on board. It needs to be a global effort.
You've been flying around the world. That's part of your job, is that you travel a lot and you talk to a lot of leaders, and you have been. And this spring meeting at the IMF and the IIF feels a little bit different than it has in the past. Can you just frame what a seismic moment it feels like it could be? Is this a regime change in a new kind of way for both the financial structure as well as the trade system going forward?
Yeah, it's true. I think of it as a new operating system that you put on your phone, right? And people are trying to figure out how it works. When it automatically downloads and all of a sudden you have these new features. They're just trying to sort their way through it. I think there was concern up until this week about the role of the dollar. Did this administration want to downplay the exorbitant privilege of the dollar and the dollar's role? I think the Secretary was pretty clear this week that, in fact, he is committed to the dollar's role as the principal global reserve currency. That's an important statement.
He may be committed to it, but Wally Adeyemo, who formerly worked at the Treasury Department and was here just a moment ago, said that every portfolio manager he's talking to is speaking about diversifying away from U.S. assets. Are you seeing the same?
Oh, absolutely. There's a lot of excitement about Europe. Europe really has an opportunity. I met with many European officials this week, and I've been spending a lot of time in Europe. This is Europe's moment to actually show that they can make some reform progress. They've got to build a defense and security industrial base. The Germans are going to spend money after not spending money for 2 decades. This is Europe's moment. We'll see if they actually seize it.
Pushed by Trump. Do they have this White House to thank for this?
It's a Trump shock. And I tell them you should thank him. Send him a thank you note, because this is Europe's opportunity to actually do what they should have done 20 years ago. It's China's opportunity and it's our opportunity. But we've got a role to play as well. We have to get our fiscal house in order.
We've said it a few times on this program, pushing the Europeans to do what's good for them.
Exactly. Trump is making them do that. He's also now tweeting and truthing a lot about how he loves that the ECB's cutting rates. They're cutting rates because the environment he created. He's almost dictating policy, monetary and fiscal, on the continent.
Yeah, the ECB stuck between the Trump shock and the China shock volume 2. That's for sure. Tim, it's good to see you. Thank you, sir.
Guys.
Thanks
Happy
for dropping
Friday
by. Thanks for being here in Washington with us. Tim Adams there, the IIF President and CEO. Lisa, you brought up the point. I think it's an important one. We've been talking about it with portfolio managers and asset allocators over the last month or so, this push to rebalance from this huge dollar long that's built up over the last decade plus.
Yeah, and it really raises the question. There's a short-term reprieve right now, and you're seeing this with some sort of assets into the dollar and into the Treasury market as a reprieve from some of the sell-off. But longer term, Michael Hartnett, you mentioned this, Annmarie, earlier this morning at Bank of America, saying he would sell the rallies because ultimately there is a slow structural shift. It's not get out of dollars wholesale. It's just on the margins, tweak it, diversify it, and you hear that again and again.
3 days of gains on the S&P, bumping into just a small loss this morning. We're negative by 0.2% on the S&P 500. Next on the programme, we'll catch up with Alifia Doriwala of Rockcreek, Doug Rediker of International Capital Strategies, the Nasdaq CEO, Adena Friedman, and Nikhil Rathi, the Chief Executive of the Financial Conduct Authority. Live from Washington, D.C., this is Bloomberg.
Investors are not only worried about the economic outlook, but the whole structure of the international system.
We all really appreciate that if global trade begins to destabilise, all that we have to lose.
Our overriding theme, of course, is uncertainty.
The world economy cannot afford a continued confrontation between the two largest economies in the world.
The world is holding its breath, waiting for the U.S. to indicate where it wants to end up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from the nation's capital, from Washington, D.C., for our audience worldwide. Good morning to you all. For investors worldwide, everything's relative, but this week, quieter than it has been over the last month so far. Equity futures, your scores look like this. On the S&P, negative by 1/10. On the Nasdaq 100, down by 0.2. On the Russell, negative by 0.8%. On the week, So far on the week, the S&P 500 higher by 3.8%. Some comfort in the bond market. Your bond market this morning looks like this: a 2-year, 10-year and 30-year, with yields lower again for a fourth session on the 10-year. We're down by 4 basis points to 427.39. The thing you hear repeatedly at the moment from the South side is time. This will take time. Mike Gapon of Morgan Stanley, the US economy may be in a race against time. Andrew Hoddenhorst of Citi just moments ago saying this: waiting for the hard data to turn. Lisa, the clock is ticking.
The clock is ticking. We did find out some aspects this week, though, about what the ramifications are for corporate America. In earnings calls, we're not making as many investments. We've slowed our hiring plans. We've expanded. We haven't necessarily expanded in the same kind of way that we had expected to. What you also have heard is a recognition, at least in the margins, from this administration that it does take time. And that is the reason why it's calmer. The bigger question is longer-term shifts away from the U.S., and that is still a question mark.
We've had a different tone from the administration, from the president, a softer tone. He's talking up talks with China that China says aren't even happening. And we're still trying to figure that out this morning, aren't we?
China today came out and said this administration should stop misleading the public. Also this morning, Time Magazine, the president sitting down with journalists at the magazine saying, yeah, Xi Jinping has called me. Interesting, though, the president did say 145% is unsustainable. He also said it's not weak to show Xi Jinping. It's not weak for him to pick up the phone and call me. So I think he's wish casting. He's negotiating out loud and hoping the message reaches Beijing.
It's something between 145 and 0. And consensus is building around this view that you've been talking about for a while, that maybe we land exactly where the president said we would land months ago.
At 60%. Somewhere between 50% and 75%, I think is what the Wall Street Journal was talking about, and an official had briefed them. But here's the fact of the matter. 4 months, you could have prepared exactly what the president was saying on the campaign trail. 10% on the entire world, 60% on China. And we might land there within this 90 days reprieve.
It's been a very volatile month of April. Still got a week to go. Equity futures on the S&P, negative by 0.2%. Coming up this hour, Alifia Doriwala of Rockcreek, as trade optimism boosts investor appetite. We'll speak to Adena Friedman, the chair and CEO of Nasdaq, on business confidence. Nikhil Rathi, the CEO of the UK's Financial Conduct Authority, will round out the programme with us a little bit later. We begin this hour with stock steady following 3 days of gains. Investors looking for clarity, as President Trump says the administration was talking with China, and China denied those talks were even taking place. Alifia Doriwala of Rockcreek joins us now for more. Alifia, good to see you.
Nice to
see
see
dropping
you.
by. You work very closely with endowments, and I'd actually like to start there because everybody is facing policy volatility, including colleges in the United States of America. Question a lot of people are asking: are they selling? Are they looking to move into high liquidity products?
I think, we obviously heard about Harvard, we heard about Yale, we've heard about very large investment portfolios that are looking to sell some of their private equity portfolio. I'd caution $1 billion out of a $53 billion portfolio is not necessarily a state of panic selling. So the amounts are large, but because they're large investors and they've been investing in private equity for the last 20, 30, 40 years. Their portfolios are extremely complicated, and this is actually a good time to be out there in the secondary market, try to get a bid, try to pare down your portfolio, and yes, prepare for what could come and maybe a period of uncertainty. But, we also expected a very dynamic IPO market, a very dynamic M&A market, and we're not getting that so far. We might get that, but we don't have it now. And so being, a little bit prudent and having liquidity and flexibility is what every endowment is looking for.
What is so complicated about their portfolios? And given the threats to the nature of their business at the moment, what would need to rebalance? What would need to change?
Yeah, look, private equity portfolios that have been built up over the last 20 years are going to have multiple line items. They're going to still be working off private equity investments from 10, 15 years ago. And so reducing your tail, some of those positions that are still unwinding, and then getting into new investments. This is all about having the flexibility to go invest for the next 10, 15 years. That's what endowments are all about. And so I think that it's a complicated business of trying to reduce that, increase your flexibility, and still get a good price on your portfolio. But that's what the secondary market is for.
This is fascinating because so many people have come on this show and say, look, it's hard to know where to hide in private assets, because private assets are the place to hide. And what you're saying is essentially private equity, which has been hurt in a couple of different factors, the fact that the IPO market hasn't revived in the same kind of way. is not it, at least not for these endowments. How much are you seeing price discovery that's a lot less favorable, sort of the washout in private equity that a lot of people are waiting for over the past couple of years?
You know, I don't think it is a washout, and I think that there are still buyers in the secondary market that are willing to bid up some of these portfolios. These are great assets. Some of these are going to be really good funds that other investors that have no private assets want to get into. If you are an endowment and you have not had a large private equity allocation, today is the day to go and see what can I actually get into for the next 10 to 15 years. So it all depends on your perspective. And, you know, we're still very enthusiastic about private equity. It's just a matter of what is the allocation in your portfolio and how much liquidity can you bear.
Stepping back, this idea of liquidity has traditionally been interchangeable with treasuries. And we've been talking all morning about whether that still is the case, especially given some of the volatility that we've seen, particularly on the long end. Have you seen any of the funds that you work with materially shift away from treasuries as sort of this ballast?
I mean, they haven't worked in the portfolio, right? So in a short-term period, you know, you're saying that fixed income is going to be your safety, your, you know, flight to, I mean, even gold. We have positions in gold. It's done great. But do I really think it's that safe? Maybe not in this environment. And so nothing is safe. I think everything is a risk today, and you have to look at your portfolio in terms of relative risk. Is fixed income still relatively less risky than other parts of the portfolio? 100%. Is it probably overplayed? How much is getting, you know, really depleted from treasuries and how unsafe treasuries are? I think the markets are changing so dynamically and fast that you can't really say what's going to happen in 6 months in the treasury market.
Because the markets are taking their cues from Washington. And this is a Trump administration. This is a 12 news cycles in 124 hours. How do you position for the long term?
Yeah, and I think that's why you've seen the bond market react, I think, more to what is coming out of the administration than you have in the equity markets. And your point is very well taken, and this is the problem, right? If you're a long-term institutional investor and you look at the market every day, those two things don't match. And you don't want endowments to be market timing. They have probably had this private equity, you know, these large asset owners that are selling private equity, they've probably been thinking about it for the last 3-6 months. And so this has spurred maybe the speed at which they do things, but this is not an overnight decision. And you can't manage an endowment with the ticks of the market every single day. You'll just be caught wrong-footed each time.
But investors are thinking about other places outside of the U.S. Who's benefiting the most from those flows?
I mean, if you just look at the markets in the short term, right, it's been Europe, it's been emerging, it's been everything but the U.S. Now, we came into this period a little bit more conservative on equities. We had rebalanced, but that's a lot, you know, I think a lot of institutional investors were already feeling that the U.S. was at high valuations. U.S. exceptionalism, yes, but how long can that persist with the market valuations we saw? So there was a little bit of a rotation. I have to say I'm still skeptical at how long-term this, you know, great Europe is going to be great, emerging markets is going to be great. We've seen that quite a bit of number of times in the last 5 years, and everyone returns to the U.S.
You work with endowments, so you're specifically vulnerable on a number of different levels in terms of policy uncertainty. Yes. There's this question around trade, what that does to the macroeconomy, but there's also this question around the universities in particular and where they get their funding, their accreditation, and how that might be changed going forward for them to be able to be eligible for certain loans that are particular to their businesses. How much do you see this as potentially spurring some sort of liquidations of some of their assets to bolster their business models at a time of such incredible uncertainty?
You know, I think university endowments have been disciplined for the most part. And so I don't, again, think that there's a panic because they are losing some of their funding unless it has been such a material portion of your budget. And some might have to increase their spend in the interim to be able to cover some of those programs that they want to continue. But it's going to bring also a financial discipline back into maybe the budgeting that the last 10 years, because you were relying on your endowment, didn't necessarily force you to do. So maybe it's also a time where universities are going to really be looking at their business model and saying, where can I pull levers? I can't only rely on the markets. I can't only rely on my endowment.
Alifia, just a final question. When we wrap up the week here in Washington, D.C., do you have a firm handle on where policy is and where things will land? By the time we get to the end of the year, do you have a decent vision of things now?
I think if anyone says they do, they have not been living in Washington for the last quarter or 3-4 months. I mean, I think we have scenario planning, and we can say that we think, you know, equity markets are going to be here, that everything will come back to the 10% tariffs. It's all about China. But I don't think China tariffs are going to be resolved in the next year. I think that's a 2-3 year game until we really see where it's going. So, you know, that's a lot of uncertainty, and there's a lot of careful positioning you need to do for our portfolios in that environment.
Alifia, appreciate your time. just to share some of your thinking with us this morning. We appreciate it. Alifia Doriwala there of Rockcreek. Equity futures at the moment down by 0.2% on the S&P, still up nicely on the week so far. The opening bell about 1 hour and 20 minutes away. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hakes. Hey, Yahara.
Hi, John. President Donald Trump expects to wrap up trade deals soon. The president telling Time magazine he anticipates finalized deals over the next 3 to 4 weeks. Trump also reiterating the U.S. is engaged in trade discussions with China, despite denials from Beijing. Meanwhile, Intel shares continue their fall this morning. They're down 7%. Now, the chip maker gave a revenue forecast for the current quarter that was well below what analysts were expecting. Plus, the CFO warned that a tariff-fueled recession could hurt chip demand. The company also confirmed plans to cut management jobs as its new CEO, Lip Bhutan, attempts a turnaround. And Walmart is increasing its focus on discounts to drive demand and grow market share amid tariff uncertainty. The retailer is introducing manager special signs to highlight price cuts on key items and match competitors' prices. That's your Bloomberg brief. John?
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the programme, the morning calls, plus Douglas Rediker of International Capital Strategies, with the US looking to strike some big trade deals. That conversation next. Live from Washington, this is Bloomberg. The opening bounce 1 hour and 16 minutes away. Equity futures doing okay on the S&P 500. Only slightly softer on the S&P. We're down now by 0.2%. That's the price action. Let's get you some morning calls with just one stock in focus. Alphabet. First up, Wells Fargo raising its price target to 175, citing resilient first quarter search growth. Your second call comes from the team at UBS, boosting its price target on the stock to 186, noting positive capex guidance. And finally, your third and final call from the team at JP Morgan, raising its price target on Alphabet to 195, highlighting the company's progress on AI features. That stock is up in the pre-market still, off session highs but still firmer, up by 3.8%. Let's turn back to the main story, trade. Here in Washington, President Donald Trump telling Time magazine he expects to wrap up deals with U.S. trading partners over the next 3 to 4 weeks. Joining us now, Douglas Rediker of International Capital Strategies. Doug, good to see you. Good morning.
Thanks for being here.
Can you get these deals done in 3 to 4 weeks?
Depends on how you define getting deals done. Secretary Bessent specifically said agreements in principle can be done much more quickly than actual trade agreements. So actual trade agreements take years. Let's just take that aside. The agreement in principle, from what we're hearing, is let's take all the controversial stuff, put it aside, find that common area where we can at least amorphously agree, and then say, deal done. So, yeah, I think you can get a bunch of those. But again, there's a difference between the announcement and the actual implementation.
Let's talk about the biggest controversy, China. Can a deal be done with China?
Can? Yes, likely, absolutely not. I mean, I tend to believe the Chinese when they say we're not talking. I'm not sure that President Trump has a lot of facts behind it when he says, yeah, we are talking, when the other side says, no, we're really not. In this context, I think I believe the Chinese.
But this week specifically, we were expecting the Treasury Secretary to sit down with the Chinese delegation. He had said that to us back in February. Do you still expect that meeting to go through?
I think that there are probably almost protocol-style meetings where, hi, how are you? Nice to meet you. I'm Secretary Bessent. That's usually what happens at these meetings when you're a new cabinet official. And so that's not to say they wouldn't raise some issues. But I really think this was supposed to be Scott Bessent's introduction to his counterparts. Remember, he did not go to the G20 finance ministers meeting, and everything was about, well, I'll meet them all when they come to Washington. Not, I'll meet them all and discuss the fine points of a trade deal. So there's a difference between introducing yourself and actually getting into the nitty-gritty.
Tim Adams was just on. He sat down. I know you were at that speech that the secretary gave, and then that interview that he had with Tim Adams. Tim Adams says this is Scott Bessent's breakout week. Do you agree? You talked to everyone from the IMF.
Absolutely. I think Scott Bessent was, I don't mean this to be in a disparaging way, but I think a couple of weeks ago, he was a diminished figure. He seemed very uncomfortable. A guy who in his confirmation hearings was a reasonably good communicator came off as a terrible communicator. He didn't sound like he believed the words he was saying. Suddenly, in the last week plus, He's standing up taller. He's got more stature. He's got more gravitas. He's got more confidence. He's clearly got the ear of the president for now. And that has come through. So I think this has been a great week for Secretary Bessent. What I worry about is that investors and officials who are here are going to misconstrue that as a long-term trajectory. We know in the Trump administration, anybody who's up this week is just as likely to be down next week, and that's probably a misleading signal if you think this is a linear path to Bessent's dominance.
I love that we're at the point of analyzing nonverbal cues as sort of a way to understand U.S. policy. Going forward, I do wonder whether we did get any sense this week of anything concrete that moves us past peak uncertainty to a greater understanding of the framework going forward, what the ultimate goals are, which players might come to the table, and which maybe not.
I think anybody who leaves Washington this week after the IMF spring meetings and thinks that there's any more clarity is probably misplaced, misguided. That doesn't mean that there weren't some signals. The signals probably were that President Trump really wants to talk to China, and that other countries know that he really wants to do these agreements in principle with them. And so they are, as I said earlier, sort of circumscribing what they're willing to talk about in the short term. So I think that there's some signaling that deals can be had. But again, if you think those deals are actually being made, I think that's probably overly optimistic.
There were some changes, though, in rhetoric, and the sort of outward comments versus what people were saying behind closed doors, two very different things. On the outward facing, we need U.S. Treasuries to be a haven asset. We need the dollar to be reserve currency. We hope that it maintains strength. Longer term, a lot of discussions about the euro and how the European region can fortify the euro, how different funds can diversify away from U.S. assets. How much was that a material shift in terms of how much that idea was accelerated?
I think for the first time in our lifetimes, we're seeing talk of the U.S. dollar as a credit instrument, not as a safe haven. And the U.S. dollar as a credit instrument is a big shift. That doesn't mean everybody's selling the dollar. But certainly the conversations I had with very large international asset managers talked about hedging their dollar exposure. That doesn't necessarily mean selling the dollar, but it does mean buying instruments, especially the euros at 115, 116. That's not a bad place to try and hedge yourself. So there's a lot of that that's going on. And again, just the talk of the dollar no longer being a safe haven, that's a very revolutionary shift in the global financial system.
Russia thought the same thing once upon a time and then had their reserves confiscated. And I just wonder if the likes of China are having second thoughts about diversifying into things like the euro.
I haven't thought, well, I mean, you've got to diversify into something.
Gold seems to be the pattern of things from the Chinese over the last few years.
I can't imagine the Chinese are going to take the majority of their dollar-based or euro-based assets and shift them into gold. And, there's always the TINA, right? There is no alternative benefit to the dollar, the euro, and others. I think Europe, classic, right? Everybody's been talking about it this week. What a great opportunity this is for Europe to step up. Oops, they're probably not going to step up. So that's, Europe is famous for ready, aim, 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 and they never actually get to the fire part. Is this a moment where they win the Charlemagne Award? I mean, where Putin and Trump win the Charlemagne Award as being the ones who brought Europe together? Probably not, but probably more so than certainly Europe would have done on its own.
Do you think we're past peak excitement when it comes to Europe?
When did we have peak excitement on Europe?
The debt break, winding down in Germany, them actually looking at potentially their own defense.
It's about as good as it gets for Europe, right?
No, I think that there's still, Merz isn't even chancellor yet. So I think that there's still a lot of steps to come. And again, I think we're getting a false sense of certainty or clarity coming out of this week. Suddenly Bessent is the savior and everything's fine. No. That's not the case. So I think there's still a lot of legs in this story to come, and Europe is going to be a central player in that, particularly on Russia, Ukraine, right? So there is going to be potentially this break. It's not what we're here to talk about today, but if, in fact, President Trump pulls the U.S. away from, if not out of, supporting Ukraine in the coming weeks, that's going to be a big moment for Europe to step up and a big schism in the U.S.-Europe transatlantic relationship on security issues, which is going to spill over into a wide range of issues.
When it comes to trade and the conversations the U.S. is having with their European counterparts and other Southeast Asian counterparts, how important are you hearing that these countries, these economies, confront China alongside Washington?
Well, the U.S. wants them to, right? The U.S. is trying in many instances to force countries into choosing. And these countries are desperate to avoid being forced to choose. If they are forced to choose, the U.S. might not be happy with the way that they choose. Not because they want to. I just want to make it clear. These countries are not saying we want to walk away from the U.S. But if they are being told it's us or them, one of the great advantages the U.S. used to have, and I say used to with a certain amount of sadness, is we were the provider of the global public good. We were the anchor of the institutional norm. We were the provider of security, whether explicitly or implicitly. President Trump has undermined all of that. So now the balance against China is our biggest trading partner for most countries in the world was the U.S. played this other role. As the U.S. plays a more uncertain other role, it's harder to use that to weigh in against the balancing that China is their biggest trading partner. It's really an own goal that the U.S. has squandered.
One of the more interesting features of this particular week, where you have the finance ministers coming together and speaking about some of what you're talking about, is the number of CEOs who are here as well for a variety of reasons. And there's this ultimate question this week about whether the idea of mutually assured destruction is a great negotiating incentive, and the idea that maybe the pain that some companies are experiencing in communicating to the White House is a tool of leverage that people had underestimated in the past. Do you think that we could say, not without some uncertainty, but say to some degree that that's the case?
I think that the concept of mutually assured destruction is don't go there, right? So it is basically to say, if you do this and the other guy does that, all of us lose, so let's not do it. You would have thought that President Trump and his advisors would have contemplated that scenario before they started going down this route. It's not clear that they actually either contemplated it or fully appreciated it. And now what you're hearing this week is that they're starting to maybe be told in pretty uncertain terms, or pretty certain terms, what the damage is likely to be. President Trump's almost pleading outreach to President Xi, call me, right, is an indication that they don't want to go there. China's expressions this morning of exclusions is an expression they don't want to go there. So nobody wants to go there. And the question is whether two kindergartners can actually decide who's going to be the first one to say, okay, fine, I'll talk to you.
30 seconds left. Not an easy question. The IMF. Does Gorgieva need to step aside? Do we need new leadership?
I'm not going to say that she needs to step aside. I think that both the Biden administration and the Trump administration, Secretary Bessent this week, pointed out that the mission of the IMF has been guilty of some mission creep.
Under her leadership.
Under her leadership. But I think she's a very smart political actor and is trying to protect her position. So I'm not sure she's going to step aside. I think many of the answers to the questions she gave this week were it's up to the membership, which is a nice way of kicking the can to the broader-based membership. I think the U.S. runs a risk that they have not approved quota reform, which means that the rhetoric of we're going to step up and take greater leadership is belied by a lack of action.
It's a diplomatic response from you, sir. Appreciate it. Douglas Rediker of International Capital Strategies. The opening about 16 minutes away. Equity futures at the moment on the S&P 500 just a touch softer. We're down by 0.2%. But the last 3 days have been really quite strong. This week, we're heading towards a week of gains. So far, through Thursday's close, up by about 3.8% on the S&P. Lots of morning movers are out there, so let's get you a few of them. Let's cross over to New York and catch up with Danny Berger with more. Hey, Danny.
Hey, John. It's still Google that is leading the individual stock gains in the S&P 500 in the pre-market session. Those shares up nearly 3.5% for Alphabet, which reported results last night after the bell. Really strong set when it comes to things like Google Search, even their cloud business doing well because of all the AI demand. Their CapEx, that also exceeding expectations, saying we have more demand than we have capacity for in our data centers. So those shares charting higher. To the other side of things for tech, though, we also heard from Intel after the bell. Completely different story. Having an outlook that disappointed, cutting their capital expenditures, letting employees go, matching the Bloomberg scoop from earlier in the week. The new CEO, his first set of results, really thin, wafer thin expectations for what's to come, not laying out any big ambitious goals for the company, but saying they'd make hard decisions. Those shares up more than 7%. Finally, rounding things off with AbbVie, we heard from them just about an hour or so ago. The drug maker Rediker's earnings coming in ahead of expectations. Their newer autoimmune drugs, those also selling well, so they lifted their guidance. Those shares up 3.5%, but they said, like so many companies that we've heard from, that their current outlook assumes no change in the trade environment, especially when it comes to things like pharmaceutical sectoral tariffs. John.
At the moment, that's a major assumption. Let's put it that way. Danny, thank you. Danny Berger there with the latest going into the opening bell, about 59 minutes away. Let's turn to the broader economy. Traders raising rate cut expectations over the last 24 hours. The Fed Governor Chris Waller sitting down with Bloomberg's Mike McKee, saying a serious deterioration in the labour market would move up the timeline for rate cuts. Michael McKee joins us now for more. Good morning, Mike. Well-followed conversation yesterday. Tremendous effort from your side. Where do you stand now and where the rest of the committee is relative to where Governor Waller is at the moment?
Well, I think basically the committee is in the same place, that if there is a reason, they will move, but they need that reason. And the biggest difference with Waller and Powell and the others is how long it's going to take to get the kind of evidence that they want to see. You heard Dr. Waller yesterday say that if inflation goes up, it's going to be a one-time thing, whereas Powell's been talking more about it being lingering. And if it's lingering, then they would have to act. If it's a one-time thing, you look through it. So we're going to have to see how this all plays out in terms of the data that we get, which, Waller says, probably won't be enough until after July 1st.
Mike, let's talk about that data. Later on this morning, Mitch, inflation expectations, the final read going into the weekend. Those numbers have been terrible, Mike. Are they set to get any better?
Not set to get any better. When you look back, the final Michigan numbers usually rise a little bit from what we see in the preliminary. And the preliminary one-year ahead inflation number is 6.7%. Analysts are expecting 6.8%. And it is the longer-term number that would figure into the Chris Waller scenario. That's at 4.4%. That's the highest since 1991. So if that goes up, it's another signal. Now, it may not mean that inflation is going to rise that much, but it might suggest that consumers will get concerned and it will change their buying behavior.
Mike McKee with the latest here in Washington. Mike, thank you. That's the soft data. We've been asking the question repeatedly, when does the hard data follow? Does the hard data catch down to the soft data? We're still waiting. The outlook for corporates gets harder. American Airlines and Pepsi joining a growing list of companies trimming or pulling forecasts due to trade uncertainty. Nasdaq hoping to provide stability in this volatile environment. And the Nasdaq CEO, Adena Friedman, joins us now for more. Adena, good morning. Good to see you.
It's great to see you. Great to be here.
Can you describe the last month for us, if you can? Just how busy have things been? Describe the volume, the activity going through your business.
Well, thanks for having me. First of all, we just announced earnings yesterday, so I think that shows a little bit of what we've been working with. We had 12.5% revenue growth. We had double-digit growth in each of our three divisions. And a couple of highlights. One is within our Capital Access Platforms division, our index business grew 26% in the first quarter because of inflows. And we had $27 billion of inflows in the quarter. Very strong futures volumes as well in our Nasdaq 100 franchise. And then we look at our fintech division that grew 10%. And one of the highlights there is our anti-financial crime business grew 21%. And that's an important key grower for us. And then within our market services division, which is our trading business, that grew 19% in the first quarter because of record volumes in the first quarter. And we continue to see those volumes persist and actually grow into April. The first 10 days of April, we had 5 of the top 6 trading days ever in U.S. equities, 4 of the top 6 trading days ever in options. And in one of the days, we also measured message traffic because that's how many messages our system's handling during a given day. On the peak day, which was April 7th, we had 550 billion messages flow through our systems on that single day. So it has been an incredible period of time from a trading perspective. And the one thing to note, because we talked about this earlier, you don't get necessarily credit for this, but the fact is that the plumbing within the markets, all of the markets, has done really, really well. Hyper resilient. I think we've all been able to manage this volume extraordinarily well. We're very proud of that at Nasdaq, and I can tell you that our markets have done quite well in this period of heightened volatility.
We don't thank you when it goes right, but we'd be very quick to criticise you when it goes wrong, that's for sure. You've handled a lot of volume, volatility good. When does volatility become bad?
Well, I think the one thing to recognize is volatility, and short-term volatility that then can resolve itself I think that's something that we've seen, frankly, multiple times over the last 5 years. I think the concern is, of course, is if we cannot have some certainty in the markets. Investors like certainty, and right now it's a very uncertain environment. So they tend to take a risk-off attitude about that. And as we know, we are hoping to see more companies go public this year. We did have 45 IPOs in the first quarter, raising $5 billion. One little side fact also is we had 7 companies switch from New York to Nasdaq in the first quarter. And we crossed $3 trillion threshold of companies that have switched to Nasdaq since we started our switch program 20 years ago. But I also would say, though, we have a lot of companies that are looking to go public this year. And right now, of course, investors are not really in a mode of underwriting a lot of risk. So we're seeing them take a wait-and-see attitude in terms of how to tap the public markets and when to tap the public markets this year.
That was a very subtle but well-placed shot over at the New York Stock Exchange. I'm sure that they will be listening. I am curious about what that pipeline looks like now and how much smaller it is now in terms of IPOs than it was earlier in the year. There's this big question, how much of deals been sort of put on hold and how much have they just been scrapped altogether? Do you have a sense of that?
I think there are more being put on hold. I mean, we have not seen companies suddenly decide they're not going to go public. It's really a matter of they've gotten themselves ready. They've gotten approval, all the approvals they need. It's really now a matter of just having a wait-and-see attitude. And they should be, in terms of thinking about how can they maximize value for their shareholders, how can they make sure that they're entering the markets in an environment that's welcoming. And that could be, you could find windows and pockets of time throughout the year to be able to do that. And we did, as I said, still have 45 IPOs in the first quarter. So it wasn't like the markets are shut. It's just a matter of finding those windows of opportunity within a more volatile environment.
Do you see companies trying to decide or having a harder time deciding whether to IPO in New York or in the United States, in the deepest markets of the world, versus somewhere else, based on the turmoil that we've seen?
Well, we are really the home to global companies as well as American companies. The conversations continue to be very constructive, robust. They're very interested in coming and tapping the American investor and frankly the global investor base. I mean, in the United States, we are the most liquid markets in the world. We have the most variety of investors. We have the deepest pools of liquidity. I think those things are constant attractions in terms of companies who want to go public. Again, it's really more a matter of timing than it's more a matter of when than if they want to come and tap the public markets here in the United States.
I was here during Trump's inauguration while you were speaking to John and Lisa over in Davos, and you were very constructive on the incoming administration when it came to the excitement around IPOs, also deregulation. You were pushing for this regulation overhaul. Are you seeing what you were expecting back in Davos from this administration now in their first 100 days?
From a regulatory perspective, we are very excited about the fact that we can work constructively with the regulators that are coming into with the positions. With Chair Atkins coming into the SEC, he has deep understanding of the markets. He has a deep understanding of U.S. capital markets and also the need for companies to have a good public company experience and how important that is in terms of giving citizens access to the growth of our economy. So we are looking forward to engaging with him. We just put out a white paper on the need for reform in the regulatory landscape for public companies to have to be able to have a life as a public company, not have it be a oh gosh moment, but more a I can't wait moment. And so I think that that's something that we're really looking forward to engaging Chair Atkins on.
How big is the tone shift from the Biden administration and Gary Gensler to Chair Atkins?
Well, he just came into office, so we are going to introduce ourselves to him. We actually do know him from when he was a commissioner many years ago, but reintroduce ourselves to him, and we'll look forward to engaging with him as he gets going in his new seat.
You've been through a lot of different market regimes. How would you describe this one? How unique is it?
Well, it's funny. I have actually been part of many market events. I've been at Nasdaq, started at Nasdaq 32 years ago, so I've seen a lot. And every single one of them is different. I have to say, there's no two situations where you see a lot of volatility that are exactly the same in terms of the causes of volatility. What we've seen in terms of the reactions from investors is pretty consistent. When the thing, as I mentioned before, is that the thing that they like the least is uncertainty. And in any period of time where you suddenly have a big moment of uncertainty, they take the same attitude, which is a risk-off attitude. I'm going to take some of my positions out of the market. I'm going to sit and wait and understand what's happening, and then I'm going to re-engage in a smart way. That's a very consistent reaction. But the causes of every single period of market volatility have been different, actually, over the last 32 years.
Certainly feels unique this moment, that's for sure. Adena, thanks for dropping by. Appreciate your time. Thanks for being with us. Adena Friedman there, the Chair and CEO of Nasdaq. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to New York and catch up with Yahara Hacker. So, Yahara.
Hi, John. Colgate-Palmolive is the latest company to cut its growth and profit outlook. The toothpaste maker says tariffs are expected to add $200 million in costs this year. In its earnings presentation, Colgate said the levies will drive raw and packaging materials costs higher as commodity prices increase. Meanwhile, the Trump administration is updating rules to allow domestically produced autonomous vehicles to qualify for exemptions to safety standards. The National Highway Traffic Safety Administration will continue to require car makers to report crashes involving self-driving systems, but with less strict reporting requirements. And NFL teams are paying a premium for the top picks in this year's draft. Signing bonuses for last night's first-round selections came in at a record 26% higher than last year. That's according to reports from Sportico. The Tennessee Titans drafted University of Miami QB Cam Ward with the first overall pick. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning. Up next on the programme, Nikhil Rathi, the CEO of the UK's Financial Conduct Authority. Plus, we'll set you up for the day ahead, going into the weekend following a long, long week in Washington, D.C. Live from the nation's capital, this is Bloomberg. The opening bout is about 45 minutes away and your scores look like this. Doing OK on the S&P 500 on the session, better than OK on the week. On the session on the day, we're down by 0.15% on the S&P. On the week, we're higher by 3.8%. Going into the weekend with one more trading day to go. Elsewhere here in Washington, D.C., the UK Chancellor Rachel Reeves meeting with the Treasury Secretary Scott Bessent at the IMF as countries line up to strike trade deals with the United States. Corporates and regulators looking for clarity as President Trump shifts the global economic landscape. Joining us now to discuss, Nikhil Rathi, the CEO of the Financial Conduct Authority, a financial watchdog which monitors over 40,000 businesses in the UK. Nikhil, welcome to the programme, sir, and sorry to miss you. You're up in New York. We're down in Washington, D.C. We crossed paths, I think, in the last 48 hours. I want to start with the nature of this shock and what it means to you personally and for the institution and ultimately for the UK. Nikhil, this is a policy shock across many dimensions. Does it have the potential to morph into a financial shock as well?
Good morning, Jonathan. What we've seen over the last few weeks has been extraordinary volatility, record trading volumes. In London, we oversee a huge global financial centre with asset classes ranging from commodities, equities, fixed income. And what you've seen is actually the financial markets staying resilient. You heard that from Adena just now, and coping with the changes in the external environment and seeking to find the price. And that is what we're focused on as regulators, making sure market integrity is maintained and the markets are functioning and preventing what you asked about, which is a policy shock turning into a financial shock.
Nikhil, one word we've heard repeatedly over the past few weeks, and I'm sure you've heard the same word, is orderly. Things have been orderly. When I think of certain vulnerabilities in the UK, my mind often shifts to the UK housing market. What is the positioning of the housing market at the moment? And do you think now is a good time to reconsider whether to lighten up some of the stress tests on, say, mortgage applications in the not-too-distant future?
You're right, market conditions have been orderly, and I think that's testament to all the work that's gone in over a number of years on operational resilience, on liquidity, on capital, and on data and vigilance in the markets to make sure that we do keep things orderly in these periods of extraordinary volatility. And the same applies to the housing market. We've seen a very significant shift in the interest rate environment in the UK, like in other countries around the world over the last few years. But the housing market has held up. Our repossessions are actually lower than pre-COVID, and we're seeing continued resilience in consumer balance sheets. And therefore, we think it is appropriate for us to have a discussion in the UK about how we support first-time buyers, access home ownership. A lot of people are paying high rents in cities around the UK, and that isn't great for their long-term financial well-being. And so that's why we've moved in that direction as part of our overall push to support growth in the economy in the UK, which is obviously an urgent need.
Nikhil, there are two sides to this. On one hand, you could say that the resilience of the global financial system is a result of some of these regulations and stress tests. On the other hand, you could say that maybe some of these consumers don't have access to maybe as easy credit because of how regulated some of the financial institutions are. Are you pushing back against what we're hearing globally, in particular in the U.S., saying let's remove some of the regulations that maybe are too stringent on the financial sector?
We've had great conversations here in the US this week. I had the pleasure of meeting Chair Atkins shortly after he was sworn in, and I'm meeting a number of my other US counterparts. And I think on the whole agenda of growth, innovation, competitiveness, I think we're aligned. And this conversation is happening in the US, it's happening in the UK, it's happening in the European Union. We have significantly improved standards of capital and liquidity. In the UK, we've raised standards of consumer protection with our consumer duty. And it's right, having done that, to make sure that the regulations are fit for purpose for the needs of the future and what the economy needs right now. And I think we're moving very fast after putting around 50 proposals to our Prime Minister at the start of the year to implement those, simplify our rules, whilst maintaining consumer protection and market integrity.
Well, I guess that another way to frame this is in the years after 2008, there was a steady march toward tightening financial restrictions on banks. And we've seen, as a result of that, financial institutions lose businesses to private ones and a whole host of other transformations. Are we going to see some modicum of reversal of that? Are we going to see going forward walking back of some of the regulations around major financial institutions around the world, not just in the United States, but also in the UK and EU?
I think you will see a recalibration, and we're well underway with some of our significant reforms in the UK. On capital markets, we've put through some of the most far-reaching reforms to our listing rules. In the last year or so, we're reforming the rules around prospectuses. We're transforming the way advice is provided in the UK so that our pension system is better able to provide capital to infrastructure and scale up companies. We're also, though, a global financial centre, and we want to make sure that our markets serve all needs. So I don't see this as a opposition between banks and non-banks. We want businesses of all sizes to be accessing the capital they need, equity or debt, from public markets, from private markets, from banks. And the important thing is to make sure that all are well regulated and that we have the data we need to monitor and make sure the risks are well managed.
Across multiple policies, really, this White House, Washington, is setting the agenda for the rest of the world. Are you concerned at all for a race to the bottom when it comes to deregulation?
That's not the message I was getting from my US colleagues this week at all. There is an energy here around regulatory reform, for example, in the area of digital assets and stable coins, but also a commitment to making sure we have high standards of integrity. I think Chair Atkins said in his statement when he was appointed that he was committed to secure markets in the US. We have a very deep relationship with our US capital market counterparts. We share considerable amounts of data, and we work really closely together on market developments, on enforcement. So, for example, in recent weeks, we've seen significant volatility in sovereign debt markets and in bond markets. There's been a significant rise in hedge fund participation in those markets. We're talking about those issues and making sure we have a good mutual understanding.
You are the first head of the authority to actually get a second 5-year term. What do you hope to achieve in the next 5 years?
Our Prime Minister has talked about rewiring the state in the United Kingdom so that we are digitally enabled and fit for purpose for the rapidly changing technological environment we are living in. And I think that applies to regulators too. And we oversee one of the world's largest financial centres. We want to be open to business, to participants from all over the world. That's based on high standards, and we want to move fast on embracing new technology too, and forging deeper relationships with all of our key trading partners. So I think you'll see us moving very fast now on regulatory reform and seeking to make sure that we are right at the cutting edge of these new technological shifts.
Nikhil, thanks for sharing some time with us this morning. We appreciate it. A busy morning for you, I'm sure, in New York City. Nikhil Rathi there, the CEO of the Financial Conduct Authority, talking about the digital age and regulation. This story just dropped in moments ago. Allow me to share it with you. The lead story coming from our team, the lead paragraph. The US President, Donald Trump, and the administration putting pressure on Europe to ditch a rule book that would compel developers of advanced artificial intelligence to follow stricter standards of transparency, risk mitigation and copyright rules. The pressure building on the Europeans from the US side on a new dimension.
On a new dimension, but this has been the message from this administration to Europe across a number of issues. Whether or not it's a digital service tax, whether or not it's now AI, you have to deregulate the tariffs when it comes to beef or autos coming into Europe. They want a more open market when it comes to Europe. And maybe potentially this is going to be a part of the grand trade deals when it comes to the European Union and Brussels.
As if that trade deal wasn't hard enough, it gets even more complex. That's the latest news from our team here at Bloomberg. The latest price action, we are negative by 1/3 as we count you down to the opening bell, about 36 minutes away. Your trading diary, the calendar looks like this. At 10 a.m. Eastern Time, we get UMich consumer sentiment, plus trade talks between Treasury Secretary Scott Bessent and the British Chancellor of the Exchequer, Rachel Reeves. On Tuesday, we'll get JOLTS data and consumer confidence. Wednesday, PCE data, plus earnings from Meta and Microsoft. On Thursday, another round of jobless claims and results from Amazon and Apple. And then before you get to next weekend, Lisa, an important jobs market report. Payrolls just around the corner.
Will it matter? Will people take a look at it and say that this is the hard data we've been waiting for? It looks like it'll be another one. If it's bad, it might have an implication. If it's good, people will say it's not actually reflecting the pain. This is the difficulty and the reason why corporate earnings still front and focus about getting a real-time read on just how companies are adapting and adjusting, as well as consumers.
The corporations in wait-and-see mode. What does it mean for this jobs market? The payrolls report a week away. That wraps up our coverage here in Washington, D.C. from the nation's capital at the IMF World Bank Spring Meetings. Thank you very much for choosing Bloomberg TV. Coming up on Monday, we'll catch up with Lori Calvasina of RBC, Abby Yoda of JP Morgan, Amanda Lynham of BlackRock, and Seema Shah of Principal Asset Management. If you can, enjoy a quiet, calm, relaxing weekend. Live from Washington, D.C. This was Bloomberg Surveillance.